committee to order. Charles, I'm going to turn it over to you to start with and then lead us into our market update. Okay.
Good morning, Mr. Chairman. It's good to be here this morning. I want to give everyone an update to where the portfolio is estimated fiscal year to date. The portfolio has been extremely resilient. Fiscal year to date, as of close yesterday, the portfolio is up a little over 1%. The month of April, though, has been an extremely difficult month. The month of April, the portfolio was off a little over 3%. To kind of give you a compare and contrast how the portfolio is done against a traditional 60-40 mixed portfolio, the iShares ETF for the same period of time, it was up 0.52%. And then the Standard & Poor's 500 itself was down around 5% for the same period of time. So that's how our portfolio is done in relation to those benchmarks. So I want to, first of all, begin, letting everyone know to remain calm, not lose perspective on what's going on in the marketplace today. Change, uncertainty, and market volatility are constants. They're always going to be there. Over the past few decades, PERS has navigated extraordinary events like the collapse of the Soviet Union, wars in the Middle East and in Europe, oil prices swinging from $8 a barrel to $147 a barrel. The rise of the internet, multiple tech bubbles and crashes, and a global financial crisis, negative interest rates on German and Swiss bonds, and 0.4% yields on 100-year Austrian bonds. Sovereign defaults, a 50-fold increase in the Chinese GDP per capita, and a 100-fold rise in software market capitalization, a global pandemic, and a period of record S&P 500 returns, followed by a decade of losses. Markets do not grow in straight lines, neither do economies. Reversing decades of unbalanced trade agreements will not come without disruptions. Current global environment is uncertain, but truthfully, when has it ever been? The future is always uncertain. Over the past 25 years, I've been surprised time and again by how markets evolve. I fully expect that to continue. That's precisely why PERS does not build a portfolio around a single anticipated outcome. Instead, we construct a resilient portfolio designed to deliver strong long-term returns no matter what the future holds. Recessions and economic setbacks are a natural part of the market system. It is reasonable to expect that over any given decade, we may experience one. We don't attempt to time them because we believe that's rarely a winning strategy. Our focus must remain on discipline, sticking to our long-term strategic asset allocation, and following our rebalancing policy. Remaining objective during periods like this is essential. Capitalism is inherently dynamic and adaptive. Time and again, it has demonstrated a remarkable ability to self-correct. The world has changed dramatically and unpredictably many times before. And yet, I remain optimistic, both about the opportunities currently in our portfolio and ones likely to emerge in the years ahead. So that's just my opening remarks. I want to let you all know that the world is not coming to an end. The portfolio is doing well, and I'd like to hand the conversation over to John Jackson, our representative with Callan, so he can go through the portfolio for last quarter.
Thank you. John, you go ahead.
Good morning, all. Can you hear me? Okay.
Yes, thank you.
Nice to see you all today. Certainly a volatile market that we're experiencing. And, I would echo the sentiments of Charles, in that we have a strategic, long-term allocation. And again, when we do the modeling, we come out every year and talk about the projections for the next 10 years. Those projections include when we, events like we're experiencing, whether it's a dot-com bubble or COVID. Again, these are in the sampling that we do, there are unfortunate events that are going to be a disruption to the markets, and that's built into the overall expected return. So that is the foundation that the structure is built on. I'm going to spend a few moments just giving an update in terms of the valuation, where we stand with the portfolio allocation, and then touch on the performance of the fund. If you want to turn to page 4, this is the highlights page. That bullet 1 is that the fund assets stood at $33.9 billion as of the end of March. And this was a decrease of about 10 million from the end of the fourth quarter, which is comprised of 2 factors. One is the investment return increased the value of the fund by about $181 million. And then payment for benefits, et cetera, came out at 191 million. So the net is a decrease of 10 million, taking into account payment of liabilities. The asset allocation was in line with the targets as of quarter end. Domestic equity was down about 2% from its target. And again, that's a reflection of their performance within the marketplace in the last quarter. And we have in the graph below, we show the short-term performance of the funds. And we have 3 bars listed here. We've got a green bar that represents the quarter. A black bar represents the fiscal year to date. That's July 1st through 3/31. And then the blue bar is the 12-month, 1-year return. So as you scan across at the green bars, one thing you notice is that first off, domestic equity, which is the U.S. equities, both large cap, mid cap, small cap, were down 4.6% for the quarter. And you'll see that global equity, which is a combination of both U.S. and non-U.S. equities, was down about 1.6%. On the other hand, the benefit of a diversified portfolio is that we saw international equities in the portfolio were up 5.6% for the quarter. Fixed income, which is comprised of both domestic fixed income and foreign fixed income and emerging markets fixed income, was up 2.3%. Real estate was up about 0.8%. And we see private equity about 1.6%. Private credit was up 2.8%, and then cash added about 2.2%. So the net is a increase in the value of the return of 0.5%. And over the fiscal year to date, that's up about 4.3%, and then on the 12-month period, up about 5.5%. But the key here is that we've heard a lot of doom and gloom coming out of the markets, and certainly that U.S. equities have suffered. The dollar has weakened, which helps your non-U.S. investments as that's brought back into U.S. dollars. We see the benefits of diversification here. So what led the markets for 24 and 25, large cap U.S. equities have sold off. But the compensation is that you look abroad and your other exposures are performing well. So the idea here is that by having a diversified portfolio, you baffle the volatility in connection with a single asset class. So that's by design. Over the long term, the total fund has outperformed its benchmark over the 5, 10, 15 years with annualized returns of 11.2%, 7.9%, 8.6%. So all those are exceeding the actuarial assumptions, but I'm going to touch on that again. 5-year return at 11.2%. So that's a blended portfolio, solid return, irrespective of the more modest returns in the last 12 months. I'll pause there and answer any questions you have about the highlights before we turn to the markets.
So the volatility is pointed out at the end of March, 4.3% fiscal year. And Charles, as you said today,
As of close yesterday, we're slightly over 1%.
1%.
That's it. It's obviously intra-month estimated number, based on non-audited,
Sure.
pricing, but
Sure.
it is close, yes.
Fortunately, we got 2 more months, May and June, right? Okay, there you go.
Yeah.
Or unfortunately, whichever may occur.
John,
No, I'm looking for, I'm saying we ain't come to bat yet, so that's what I'm saying.
you don't see any heartburn with that 10.5 decrease of causing any major heartburn? According to a decrease of approximately 10.5 million from the end of the fourth quarter. You don't see any heartburn with that?
If you're talking about the US equity markets,
That's correct.
Harper?
That's correct.
Yeah, okay, so that 10.5 million decrease, that is both, that's a combination of investment return and payment of benefit payments. So for the investment return for that first quarter was actually 181 million positive. But then you had to pay your pensioners, and that's where the $191 million outflow comes. So that's more of a consistent, with the exception of the fourth quarter where you have that additional payment. But those payments are going to go out paying that liability each and every quarter. And the variable amount is the increase of $181 million. Would we like the return to be in excess of 0.5%? Absolutely. Do I have heartburn? I do not. I think, again, we're in this for the long haul. It's a long-term investment program. There will be quarters where it'll be up, be down. At the end of the day, we look over long periods of time to see how the fund's performing, and certainly that's the case. If I were to go back and look at how this fund has performed in other years where it's been negative returns, 2018 and 2022 come to mind, where that was a period where the benchmark was negative. And in those particular years, the fund actually outperformed its benchmark as well. So again, did it generate a positive return? No, but again, in a period where markets are declining, if you're positive or less negative, that's good news from an asset allocation perspective. Okay. Great, let's turn to the markets. And so as I said, we've had leadership changes, interesting times. Certainly, we have the priorities of the administration to level the playing field in terms of the trading situation. So we have tariffs being introduced, and at the outset, you're saying, okay, what is the impact? Well, the upside is there's a number of things, if successful, will add to the economy. Supporting U.S. manufacturing, encouraging exports over imports, shrinking the trade deficit that exists, making supply chains more secure because they're onshored, deter unfair trade practices, force other countries to the negotiating table. So again, the one thing that the market doesn't like is uncertainty, and that's what we have. We have uncertainty. A lot of these actions are taking place, and in terms of a cohesive country-by-country strategy, that has not been articulated. That's not to say it doesn't exist, but certainly the marketplace isn't aware of exactly how it's going to be implemented and for how long. So we've seen the administration zig and zag on the tariffs, whether it's going to be country by country or it's going to be more of a broad case. So I say that because, hey, if things work out longer term, and these are longer term efforts, in the short term, there may be pain associated. You may have inflation for shorter periods. You may have slowing growth, depending on what the outcome is. But the outcome is not certain, and that's the key here. So what do you do as trustees, as plan sponsors? You do what you can. You have a plan in place. It's long-term in nature. Shorter-term actions may introduce uncertainty, but sticking to the strategy for the long term has benefited this portfolio and will continue to benefit. Right, so turning to page 5, employment rate at 4.2%. So we have a solid employment picture. GDP has a little bit, it's kind of an interesting time. We had a strong fourth quarter coming in at 2.3%. What does it look like for the first quarter? The numbers have not been disclosed yet, but the idea here that you have Certainly consumer sentiment is a big factor. So the hard numbers coming out of the economy are fairly benign. But with something like consumer sentiment certainly has dropped because they're uncertain. And GDP, 70% is accounted for consumer spending. Consumer spending has been resilient, but again, there's caution, there's concern there that will have an impact. One of the impacts has been to drive up in the first quarter, an increased purchase of imports. Why? Is because before tariffs take effect, people are buying cars. They're going out trying to get ahead of it. So that's influencing the GDP numbers for the first quarter. Headline CPI was at 2.4%. This is coming down a little bit from what it was in February. But again, the expectation is where you have a tariff in place, it is inflationary. And now it's a question of like, are you managing the economy for the current period or the longer term? Fed met several times and held rates steady. And they're taking the same position that they don't want to cut rates until they're required to do so. They're taking a wait and see attitude with respect to how trade and the policies of the administration are taking an impact and affecting the economy. To turn to page 7, to Charles's point, is that you've got the tech bubble, GFC, COVID, inflation rate hikes, and then the current, which is highlighted in orange. And I would point to the COVID, the most recent other event was in blue, which showed that sharp decline. So takeaway here is that the markets have declined precipitously because of the disclosure of policies and unwinding of policies. So that certainty is not there. So it's a very short-term action. Now, what you see is when you saw COVID precipitously drop, you also saw a rapid increase. And the translation is there for those that are trying to time it, to say, okay, we're going to modify our allocation, we're going to go bigger concentration in cash. The problem is that when these inflection points pivot, you've missed out on a rally. And therefore, we're firm believers in the approach of long-term allocation, stick to your allocation, rebalance thoughtfully. By the way, on the topic of rebalancing, we talked about how $191 million came out of the portfolio to pay benefits last quarter. Where did that come from? What we do is, or what staff does, is look at what the current distribution scheme is like and where are the funds available. If we have opportunities to take money from asset classes that have outperformed to kind of rebalance down, they do that. And that is a very inexpensive approach to meeting your obligations because you're not buying and selling all the time. Okay. Turning to page 10. A lot of numbers on this. This is my favorite table, by the way. A lot of numbers here. Give you some sense in a very succinct fashion of how are things performing, how have things done. If we look at the Russell 3000 and the S&P 500, these are both U.S. equity indexes. Russell 3000 is 3,000 of the largest securities, S&P 500 is 500 securities, but they're both large cap in nature. And you'll see that both of them for the quarter were down 4.7% and 4.3% respectively. Small caps, which are more economically sensitive, are going to react unfavorably in an uncertain market, and it was down a 9.5. And we look over the 1 year period, however, we see that the S&P 500 was still up 8.3%. Over the last 5 years, it's generated a return of 18.6%. So let's take a look at that number. That's 18.6% per annum over the last 5 years. And if you were to look back to, say, 1926, you would see the S&P 500 generate an annualized return around 10.5%. So again, what we saw was a tremendous run in the last 5 years, taking into account corrections, 2022, but performing extraordinarily well, well in excess of historical returns. So the idea here is that we're going to turn to Trustee Breland's chart a little bit later, but whether you say that in the fourth quarter, as of year end, U.S. equities were priced to perfection, and then any adjustment or any disruption to that outlook is going to have a pronounced impact on them. And that's exactly what happened. That's not to say that you can time it to be in and out of U.S. large cap equities, again, sticking to the long-term plan. Let's turn to global ex-US. These are non-US equities we're talking about. We've got 3 listed here. We've got the non-US equities developed, we've got emerging markets, and we have small cap. And like the US, we see that small cap had underperformed. Emerging markets was up 2.93%, and developed was up 6.2%. Over the last year, we see that the World ex-US, this is a larger cap index, was up 5.3%, over 8% for emerging markets. So again, emerging markets has had some term, it does generate a nice return. Fixed income, up 2.8%. So again, in a period where equities underperformed in the US by a significant amount, the Bloomberg aggregate is dominated by US fixed income securities. One thing I would add, that 2.8% over the last year is up 4.8%. Over the last 5 years, it's been down 0.4%. Fortunately, your portfolio has not only US-based fixed income, but you have emerging market debt, and you have non-US fixed income that's hedged to the dollar. So taking that currency risk out of the equation and investing in foreign bonds. You're going to have these folks come in and talk to you today, and couldn't be a better time with so much happening in the US, non-US dynamic. But suffice to say, that complement from a structural standpoint has been usually additive in terms of the overall return. Real estate, what we have here listed, the real estate index comes out about 30 days after quarter end, so we don't have that. So what we've rolled over the prior quarter. So when we come back in June, we will have an updated value for the quarter here. But over the last 1 year period, 2.3% from private markets and 9.94% from the NAREIT, that's your REIT stocks. So again, when you think of REIT stocks, think of small cap equities. And again, they have a yield component, but they are certainly tradable. Therefore, they react to the public markets as well. Over the alternatives, we have private equity, that 8% from Cambridge. That's as of 9/30, because we have a delay in the reporting of that. Senior debt up 10.2%. And then below, you'll see the inflation number at 2.4%. So it's a little bit north of the Fed's target of 2%, but again, certainly going the right direction. Expectation, however, depending on how these tariff policies come out, the market expects to see an increase in inflation. So let's turn to page 11. And again, this is reminiscent of what you saw on the first page, right? When you look at the negative 4.7%, that is the Russell 3000. But if you scan over to the last 5 years, that 18.2%, that is also the Russell 3000. So poor calendar year to date, but you can see that over the 5-year number far exceeds that of the MSCI equity, which is your non-US stocks. So you can see that over the last 5 years, US equities up 18% versus non-US equities at 11%. Certainly a nice premium. And again, rather than losing faith, you are committed to that policy, and then you see a nice return for the calendar year to date as you see the last quarter, non-US stocks were up 4.6%. Contrast that with the negative 4.7. So again, baffling that volatility, staying true to your allocation. Below we have returns, just to give you an update. Month to date, the Russell 3000, and this is baked into the numbers that Charles gave you, the Russell 3000 is off 8%. So again, the Non-US equities, which is below that, the equity ex-US, down 0.22%. So again, the benefit of diversification, we have it, yes, non-US equities were down, but less than 0.5%. The Bloomberg aggregate, this is dominated by US fixed income, was down 1.3%, and the global aggregate was up 2.8%. So you can kind of see the diversification benefit that takes place here. Okay, let's turn to page 12. So this is the Callan periodic table of investment returns. And we have the calendar year returns shown. You see that over the last 4 years, large cap equities have really driven the market. So if you look at 2021, large cap equities, 28.7%. 2023, 26.29, 2024, 25.02. Now, in there, you also see that 2022 was down 18%. So the point here is that in any given year, you can see the leadership may or may not change. This is kind of a short period, so we see that large caps US have been dominant. But you have years like 2022 where it's good to have different types of investments to kind of baffle the volatility. For the first quarter, when we look at the quarterly returns, you see the non-US equities at 6.86 leading the pack, followed by emerging markets equities, followed by fixed income, longer duration, and then intermediate. Real estate, high yield, and then you'll see large cap equities at the bottom, followed by small cap equities. So again, the idea here is that in any given quarter, in every given year, leadership may change. That's why we have a compilation or a balance of different asset classes. 13. What a difference a quarter makes. If you look to the right for the quarter ended, you see the Russell 1000 growth. Okay, so the Russell 1000 is of the 3,000 largest stocks in the market, the Russell 1000 is the largest 1,000 stocks. And when you divide these stocks into growth characteristics and value characteristics, what you have is certain sectors make up a bigger portion of that portfolio. So when we look at 1,000 growth, dominated by information technology. We see for the quarter, the Russell 1000 growth was down 10%, whereas the Russell 1000 value, which is got a greater concentration of financials, we have that up 2.1%. So again, as you scan down, you can see the sector performance. You see that consumer discretionary was down 13.8%, information technology down 12.7%. So we talked about the Magnificent Seven driving the market in the past, 6, 7 quarters that we've been together. And this is a quarter where it underperformed. So again, price to perfection, disruption occurs. We see there's a big sell-off. Result is the Russell 1000 growth posts a negative return compared to its value counterpart. So the bad news is growth stocks underperform. The good news is value stocks outperform on a relative basis. So the idea here that you have value managers in place to take advantage of that. In your global sector, you have LSV, which is a value-oriented manager that did post a positive returns this quarter. So again, bringing it back home to say, okay, these are the indexes, how they perform, but your managers are generating performance. So if you look over the 1 year though, you'll see that the Russell 1000 growth was up 7.8%, value up 7.2%. So over the 1 year period, they're both generating 7% returns. They're just getting there different ways and at different periods. And the idea is when you put them together, you're baffling the volatility. This is Trustee Breland chart, page 14. And what we have here is, this is the S&P valuation measure. So the key, this is a chart that's produced by JP Morgan. It demonstrates historically, are US equities expensive or relatively cheap? And we see that here are the metrics at the top. But if you look at the graph, it's got the 30-year average at 16.7%. So that's telling you over 30 years, the average PE ratio for S&P 500 was about 16.7%. Standard deviation is, again, is a series of returns, and 66% of the returns in the period captured represents one standard deviation. So we follow the blue line, we see that, okay, in 2021, the S&P 500 was, between 20 and 21, after surge post-COVID, was very pricey. We see that it corrected, and then post-2022, we see that it rose to period end 2024, and then we see the correction taking place in the first quarter as it dips down. So the idea here is that, is it overvalued? Well, by historical standards, it's on the upper end of its valuation. Okay, it doesn't exceed one standard deviation any longer, but it's pretty much in line towards the top. In other words, it's still pretty heavily priced, and that's still driven by a lot of these equities that have performed so well. Okay? Emerging markets, or global markets, non-US in particular, we see that in this particular quarter, China was up 15%, and over the one-year period, up 40%. That was really driving the emerging markets return, as you can see. You can see that in the non-US markets, value stocks are outperforming growth stocks. So in other words, stocks like financials and consumer durables performing better in this type of environment. So value stocks performing similar to in the US. Any questions on that? The US dollar has been dropping in value, and again, dropped 4% in the first quarter. So the result is you earning money abroad, and then when you bring that back, it enhances your return because you're buying dollars at a lower pace, right? So a weakening dollar is good for US investors invested abroad because they get a currency bump when they bring it in when they're buying dollars, okay? So here we see that 4% is added to the return for your non-US investments. Lastly, we turn to fixed income on page 16. And again, we see that the Bloomberg aggregate is dominated by US fixed income securities. Rates declined during the period, and prices go in the opposite direction as rates. So we saw a positive return. Bloomberg aggregate was up 2.8%. Any questions on that? The high yield, which is non-investment grade, it was up 1%. So it trailed, and largely due to the fact that people were gravitating toward the safest securities they could find, US Treasuries, which dominates the Bloomberg aggregate. Over the one-year period, we see, consistent with the equity markets, the Bloomberg high yield was up 7.7% versus the Bloom Ag at 5.5%. So that's kind of a snapshot of the markets and the different sectors within the markets. Are there any questions that I can address? Okay.
John?
Yes.
On manufacturing, what's the being brought back to the United States? I mean, what are the pieces you think that would be successful for that, and what may be pieces that wouldn't be? I mean, it seems like construction would benefit. Seems like they may be lower wage jobs, but maybe not, depending on what type of jobs there are. Any thoughts on how practical that is?
Yeah, I think it's where you sit is where you stand on that issue. Those that are bring more jobs back to the U.S., while employment is unemployment's at 4%, it could be a little bit better, but certainly that is a full employment type number. But the idea here is that you can bring back certain products and services and into the U.S. and put people to work. Now, The counter side to that is, okay, are the US citizens interested in doing that type of work? What is the wage level? What is the timing, right? So you want to do more manufacturing in the US, you've got to build factories, et cetera. What's the timeline for that to take place? And at the end of the day, the reason why, globalization was successful was that no matter what you do, you can get it produced cheaper abroad. And then that they may be input into vehicles that are imported, or they may be inputs to things that are manufactured here in the US, and they're cheaper. And if you put a tariff on there, now you're increasing the cost. And who's going to bear the cost? Are the importers going to eat the difference and not increase the prices, or are they going to increase the prices? And then the folks that say, well, they're going to increase the prices, so then you're going to have an inflationary impact, and without a corresponding increase to the wages. So we've heard everything. Even Chairman Powell at one point said that inflation rates in connection with tariffs might be transitory. And that's like a bad word after, we talked about spiking inflation. And then he's backed off from that. So again, the jury's still out in terms of how successful the timing and would that be effective? Or it could be that this is an effort to renegotiating the trade agreements, leveling the playing field. And that, so until it kind of pans out, until you see what the result is, it's pretty difficult to say, what's going to be a successful component? What jobs can you bring back to the US? Will we have sufficient people to do it? What's the immigration card going to do that? If immigration's down, how is that going to impact that employment picture? So it's a complex issue, and certainly differing opinions across the board, which adds to the uncertainty. And the deals aren't done yet, so we don't really know what is the end game here. So I wish I had a clearer explanation, but that's the best I have.
Thank you.
Okay, page 18. From a trustee perspective, it's about allocation, right? Very important. Account for the driver in performance as well as volatility. And we see that, you look at the table, we have the asset classes listed, the dollar amounts, the actual weights, and then the target weights. And we see that the biggest difference is the domestic equity being down 2.6% from target. And that's really a reflection of, again, the performance of equity. So again, as payments are continuing, will be taken from our liquid components, so fixed income is overweighted about 2%. That's a liquid area. Real estate is down 1.1%, but again, to get that invested is certainly it's an illiquid asset class. And private equity, while we're over 1.4%, again, private equity is spinning off cash, but not to that degree. So again, certainly within 2.6% as well, well within the bands that we would think would be acceptable. So we would say you're in line with your allocation. Page 19, this provides a cash flow summary and shows that the December market value was at 38.8 billion. Your investment return was 181 million. And you can see that the black numbers above that are all positive, and domestic equity and global equity, as we saw, were negative returns for the period. Net new investments, this is money that, again, is taking into account transfers, also taking into account money that's been sent back to the portfolio and then moved to another portfolio. So we see that the amount that needed to be paid was 191 million. The bulk of that, 113 million, coming out of cash. And we see that the other items, net new investment, about 255 million taken out of international equity. So again, taking money from certain asset classes to meet the benefit payments. Turning to the performance page on page 20, this breaks it down by asset class. And again, no surprises. We saw last quarter, domestic equity was down 4.6%. And that was better than the benchmark. So again, no one likes to be in a beat the slowest person in the class, but this is certainly positive. Global equity at 1.7 negative versus 1.6 negative, again, outperforming modestly. International equities, this is a bright spot. We saw up 5.6% versus 4.6. Fixed income, trailing for the period, but I guess what I would highlight is look for the 3 and the 5-year returns. These are annualized numbers, and you can see that the fixed income portion of the portfolio was up 1.5% per annum versus the benchmark, which was down 40 basis points. So again, that's active management. That's allocation to diversifying strategies that benefited the portfolio. All right. While we're looking at the 5-year returns, you can see that your domestic equity, 18.2% versus 18.18. Certainly, it's nice to see, particularly in an environment where U.S. equities and the market has been so hot over the last 5 years. To keep pace with that is certainly a good job. We see global equity off about 60 basis points. We see that international equity was up over 1%, about 1% over the benchmark. So again, that's strong returns due to active management. We see that real estate beating its benchmark, private equity outperforming, and then cash. So over the last 5 years, we've seen an 11.2% return versus 10.7 for the benchmark. So certainly looking at the 5-year returns, looking at the 7-year returns at 7.76 on the next page, 7.8 and 8.6 for the last 10 and 15 years, respectively, outperforming the benchmark. These are all good signs, and the idea here is sticking to the approach. Page 22 and 23, this is kind of just want to call your attention to a discussion point that I made. In the markets where the benchmarks were negative, the benchmark return, looked at 2022, you'll see that the benchmark was down 14.9%, and the fund performance is down 13.6, and then over 2018 was down 3.7 versus down 5.2 for the benchmark. So the takeaway here is no one likes negative performance or when the markets are negative, but this fund has been resilient in those type of markets, and certainly as you look across the calendar year periods, you see outperformance in 2020, 2021, and falling short in 2023 and 24. So that is my prepared remarks. I'll be happy to spend any more time answering any questions that you might have.
Charles, I have a question for you. As just a rough rule of thumb, is there a way for you to say, oh, well, the market is up 1,000 points or down 1,000? Okay, that affects our percentage. Do you have any kind of rule of thumb like that?
No, really, because especially in markets like this where you have, the dynamics have changed so much, where we had an extremely bad day yesterday in the markets for U.S., but I mean, it was offset largely due to fixed income in our international exposure. So it's.
Yeah, well, we don't have any idea about the internationals
Right.
and that sort of thing. So you just really, there's not a quick and dirty way for me to just look at it.
No, I just.
Dow Jones and say, oh, well, okay.
Every.
That's fine.
Yeah, every morning I run an estimate return based on asset values of the portfolio, and I generate a quick, estimate of where we're at. And
Yeah, well, I'll call you if I want to know. I was just wondering if there was a quick and dirty way I could think of it. So
if you wanted to, if you could take a look at our asset allocation and then take each benchmark by its weight relative to what we have. And that's a fun exercise.
That's not quick and dirty to me.
Yeah,
okay?
so
Well, historically, Charles, would it not be that if the S&P is up by however many points, that the fund's probably not up by that many points? But when it's down, it's also not down by that many points.
So that's true, but then you have extreme situations like we had during COVID where everything correlated to exactly the same and everything was down 100 regardless. So
But in
it-
general terms,
in general terms,
historically,
historically
because of that
it's been
defensive
true.
position, we're usually not doing as well whenever US
Right.
stocks are doing really good, but usually aren't doing near as bad as they're doing whenever they're
That-
going down.
That is true.
The best I can do is if the market's up, we're probably up a little bit. If the market's down, we're probably down a little bit. And if it's a lot, we're probably down a lot. That's about as quick as dirty as I can get.
A lot better than my first year here at 2008 when everything was down, and 2020 when everything was down.
And
At least there's some.
That was an exciting period, watching a decade worth of growth disappear almost overnight. So, yeah, I don't want to go through that again. So that was too exciting for me.
Y'all go ahead.
Well, the next item that we have on the agenda is discussing our global equity manager search. Back in December, this committee gave us the authority to initiate a search to replace one of our global equity managers, Epic Investment Advisors. And over that time, over the last 3 months, we reviewed, sifted through information on hundreds of managers in this space. And, through that process, we narrowed it down to 7 different investment managers. Each one of those managers, extremely good in what they did. Any one of them could have effectively managed these assets in this place. But what we staff and our consultants basically narrowed it down to was one particular manager kind of shined above the rest. And it's PGIM Quantitative Solutions. They showed a very good ability to be able to produce very good absolute returns and very good risk-adjusted returns. The process produces alpha by not exposing us to risks that are not compensated. I've included a couple of charts, some risk-reward charts for your review, as well as some excess return and tracking error charts against what their benchmark will be. All very strong performance numbers. And then on the following page, I just included some bullet points on what quantitative investing is and some of the benefits that it produces. Quantitative processes have kind of come into their own with the improvement in technology over the last decade, and have shown very good repeatable performance. So I'm going to let Alex comment on anything that he wanted to from Callan's.
Before you go on to Alex there, I did not look it up, but approximately how much money will PGIM be?
They're going to be, give me 1 second, I'll tell you. It is going to be, it's going to be approximately 900 million.
Okay, thank you. Hey, Alex.
Great. Well, thank you. And, we provided this kind of supplemental deck based off the search process, just, to make sure that you all have the information at hand and kind of get a snapshot of what staff and Callan used to arrive at the decision. Just to quickly rehash, this is always a very collaborative process, and our idea is to really leave no stone unturned, right? So when we're doing these searches, cast as wide a net as possible. As Charles mentioned, looking at potentially hundreds of candidates out there, right? Culling it down over time through multiple lenses to arrive at a small subset, and ultimately what we have today, one recommendation to the board. We do have some information on fees that I won't cover. Suffice it to say that the offering being brought to you today is incredibly competitive from a cost perspective, which is something that we want to see. We don't look at that until usually the end of the process. We don't want that to kind of color our views. But when those two things come together, as they have in this search, that is a really great outcome for PERS and ultimately the beneficiaries of the fund. And then the last piece of information, given today's discussion on page 12, I think is pretty relevant. One thing we discussed and debated throughout the process is what would the experience be like for PERS, for staff in their monitoring capacity, and for the board, from an oversight perspective. If you look at the second line down, PGIM, we decomposed their returns into how did they perform during up markets when markets were doing good, and how did they perform when markets were doing bad, kind of like they are right now, when markets are selling off. And what you can see, and what we want to see, is that when markets are doing good, they're participating in that. Hopefully that ratio is over 100%. So they're capturing a little bit more of that market beta, right? They're doing great when markets are doing good. But equally importantly, if not more importantly, is what do they do when markets are bad? And so that's in the column on the right, that down market capture, we want that to be less than 100%. So when markets are, selling off, they're selling off less. That's one of the big values of an active manager, is that they can protect your capital in these volatile market environments. So under both of those types of environments, they have demonstrated the ability to do well when markets are good and protect when markets are doing bad. Okay, and so when we're talking about hiring an active manager, we wanted to see evidence of that, and they showcased some consistency in their ability to do that. So that gave us great confidence in this candidate. The rest of the information, as I mentioned, covers performance on a historical basis, really just a supplement to the board. But we're happy to answer any questions you may have about the process, the candidate.
On the process, every time I see PGIM, it's got simulated. I went to the back of your deck and I read the page. Would you translate that simulated page to me and why we had to simulate the data for them there? That's what I read, was we didn't have actual data for the time that you were looking at. You had to simulate it. Is that essentially what that was, and how and why you had to do that?
This process is a quantitative process that when we were speaking with PGIM, we let them take a look at what our portfolio needs were. And they designed a portfolio to produce the returns that we were looking for within a certain percentage of tracking error. It's not a active process that's currently, an active portfolio that's currently in place. It does mirror an active portfolio that they do have currently running. It uses the same process, but what they did for us is they built a custom portfolio to feed what we needed for that particular spot in our portfolio. So instead of just taking a kind of off-the-shelf product and trying to shoehorn it into what we needed, we told them this is what we were looking for, and they came back with something that fit right into spot exactly for what we needed. So that's why it's, legally you have to put, compliance-wise, that it's a simulated performance. But why you can do that with a quantitative strategy is that you can put rules in place and then run those backwards. And you don't have to worry about the human biases, because you tell the computer what it can and can't do, and it does it. And then what you do is then you take that stream of returns, and then you run it against a current strategy that they have in place to see how it reacted in tandem with the active portfolio. And as long as you're not seeing anything that's out of kind of character with what they're doing in their active portfolio, you know that no games were being played. So that's why it says simulated.
That was the question I forgot, I couldn't remember. about the
Not
simulated.
too unsimilar to what we did when we hired the Northern Trust International Small Cap account, which also very good fees and since inception, incredible performance. So
Thank you for that explanation, I appreciate that. So we have now, I believe, a recommendation of staff. We got other questions?
well, we have them here to
Okay.
to visit with us
I
and
think we got a question or so.
Yes, thank you, Mr. Chairman. Not sure how to word this. What's the likelihood this could have been a different recommendation if the fees were equal?
well, I personally, I ran net of fee performance just for myself, just to see how things were different. If all the fees were the same, so just on a gross level. And the reason I did that is because I wanted to see, you know, if fees were consistent across the board, what would things look like? And then also, you can do that on a gross level, just gross fee performance. The PGIM portfolio still provided us what we were looking for, even without the lower fee. So it was,
Mr. Breland, I did notice that same thing on page 9 when you had the returns in the peer group ratings, and also you compare the rolling 3-year periods. I got red marks on mine. Thank you for that question. Yes.
Thank you.
and also, I mean, as far as fees go, you know, and investment performance, lower fees are guaranteed. Those are absolutely guaranteed.
So how do you talk about these folks? Is PGIM or PGIM?
They go by PGIM, but it's Prudential.
Okay.
We currently use Prudential to run a fixed income portfolio for us as
Okay.
well. So we have an existing relationship with them.
Okay, Nick, you said that they are here.
They are here and they
Okay,
are
and-
ready to tell you about their process and how exciting it is.
Okay, it's 11:30. I would suggest we go ahead and hear these individuals, and then after we hear those individuals, any questions that we have, we'll ask of them, and then we'll proceed to the vote after that.
That sounds fair.
Is that, and then lunch. Does that sound good? Okay, why don't we go ahead and invite them in then?
I will go get them.
Heard it out of my head. I got them turned up so loud. The introduction.
Yes, sir. Mr. Chair, we have our representatives here from PGM, Stacy Mintz and Kevin O'Rourke. Stacy Mintz is the Managing Director of the Quantitative Solutions Department. And if you want to know anything about quantitative investing, she has written many very good white papers. I have read almost all of them, and they've been very informational. And then Kevin O'Rourke is Managing Director and Head of East Coast Sales. So I am going to turn it over to y'all. Thank you for visiting.
And just so you'll know, we do have the document from which if you'll just tell us the page number, we can follow right along.
Super.
Thank you.
That sounds great. Thanks very much. Thank you, Mr. Chairman, investment committee members, board members, and PERS staff. As Charles mentioned, my name's Kevin O'Rourke. I'm a member of the client relations team at PGIM Quantitative Solutions. Stacy Mintz is the head of our quantitative equity investment team. On behalf of Stacy and all of my colleagues at PGIM Quant, I'd like to thank the Public Employees Retirement System of Mississippi for this opportunity and say we would love to be your global growth equity manager. I understand we have 40 minutes for our discussion today. Is that still the case?
No.
All right.
No.
No?
No.
Be our guide.
I'll defer to you.
Do what now?
I'll defer to you.
It's 11:34. I'd like to keep it about 30 minutes.
Okay.
Is that okay?
Great.
Good.
Super.
All right.
Just in terms of a roadmap today, I'll start with an introduction to PGIM and PGIM Quantitative Solutions. I'll introduce our global growth equity strategy. Stacy will walk you through our investment philosophy and process. And lastly, we'll close with what you can expect from PGIM Quantitative Solutions if you do hire us as your global growth equity manager. Is there anything else you'd like us to cover today? I promise you we're not going to go through every page in the deck. Why don't we start on page 4? This is an overview of PGIM. PGIM is the global asset management business of Prudential Financial. Collectively, PGIM manages over $1.4 trillion, which makes us one of the largest asset managers in the world. Our business, Stacy and my business, is highlighted on the blue box on the page. PGIM Quantitative Solutions is the multi-asset and quantitative equity business of PGIM. We manage $111 billion. The name PGIM may be familiar to some of you, and that's because our colleagues at PGIM Fixed Income have proudly served PERS for 13 years as one of your fixed income managers. So thank you for your relationship with PGIM already. If we jump ahead to page 5, it's an overview of our specific business unit. PGIM Quantitative Solutions was set up as a business unit by Prudential 50 years ago in 1975. We're celebrating our 50th anniversary this year. We launched our first quantitative equity strategy nearly 30 years ago in 1996. And today we manage over $33 billion in systematic or quantitative equity strategies. When we jump ahead to page 8 in the deck, is our name, PGIM Quantitative Solutions, indicates we have a long history of creating customized solutions for our clients. And the global growth equity strategy that we're presenting today is a terrific example of that. And I say that because it's a customized version of the strategy that you see on page 8, our global all-country equity strategy. This is a highly diversified portfolio investing across both domestic and emerging markets. It provides balanced exposure to both growth and value stocks and is benchmarked to the MSCI ACWI IMI index. It has an 8-year track record dating back to 2016. And if you look at this strategy relative to its peer group of over 400 global all-cap equity strategies, it ranks among the best in the industry in terms of consistency of excess returns, risk-adjusted returns, and trailing annualized returns. I'll jump ahead to page 11. This is a profile of the global growth equity strategy that we're profiling today. As I mentioned, it's a customized version of the global all-country equity strategy. It's also highly diversified, uses the same benchmark, invests across both developed and emerging markets. The key difference between the global growth strategy and the global all-country strategy is that it will have a very systematic overweight to the fastest growing growth stocks in the global equity universe. It's driven by the same systematic investment process, but we're achieving this growth overweight within the process by making a very subtle adjustment within the portfolio construction stage of our investment process. This will produce the portfolio with very distinct growth characteristics in all market environments. I'll stop there, see if you have any questions. Otherwise, Stacy will take you through our investment philosophy and process. Great. Stacy?
Thank you for having us here today. So our goal is to achieve high risk-adjusted returns for our clients. And we've done that successfully for 30 years in the equity space. And the key reason is that we've had the same philosophy through that entire time. So I want to take you through a couple of the key points of the philosophy. If you look on page 12, we talk about consistent alpha. And that's consistent excess return that we can achieve because we have a stock selection model that's based on company fundamentals. And what that means is that we look for the same things in an attractive investment that a non-quant or more concentrated manager would look for. We look for companies with good growth prospects that are high quality and are reasonably priced. But the difference is we're able to put our investment insights and requirements into a model that we can apply systematically to tens of thousands of stocks around the world. So when we're building a portfolio, we're dispassionately applying our collective investment expertise on what these good investments are. Importantly in this model is that we have always looked at growth stocks differently than value stocks. So it is not a one-size-fits-all model. It adapts to the type of stock we're looking at. And I'll get into a little bit more detail about that later. But the important thing here is that when we're managing our core strategy that Kevin described, the growth stocks in that strategy have always had a different lens than the value stocks in that strategy. So for us to run a global growth strategy, we're not changing anything with the way we evaluate stocks. We're just focusing more on the growth side of the spectrum. As important as having a good stock selection model is to be able to take those stocks you like and put them together in a portfolio that has proper risk controls. You want to focus your exposures where you think you're going to get excess return from and minimize other exposures. So when we go through the portfolio, you'll see that we don't take big country bets, we don't take big sector bets, and that's really because there's a lot of emotion and macro, a lot of stuff moving things around at a country level that is not our area of expertise. We're good at picking high quality stocks, good growth stocks, and building a portfolio from the bottom up. So paying attention to how you put the portfolio together is very important. Research, you've got to continually evolve your strategies. These days, it's a great time to be a quant. There's a lot of information out there. There are new data sets available all the time. There are new techniques. So we can look at, obviously, things from the income statement and the balance sheet and earnings estimate revisions, but we can also use tools to read through textual data and get insights from things like company earnings releases and general news and things like that. So we have a lot of great tools to be able to get a really holistic view of a company. So our research is focused on continually evolving, looking for more data sets, making sure that what we come up with really meets our high bar for inclusion into our model. We want to make sure that what elements that we add to the model are work across the world and through different market caps, so they're very appropriate for a global strategy. We want to make sure they're additive to what we already have. We have a great model right now. We want to make sure that we add only things that are worth it to that model. And we want to make sure that they make sense from an intuitive point of view. We want to understand why our model works, why it worked in the past, and why we believe it's going to work in the future. So we have a robust research group that really focuses on that. And then finally, we are a trusted partner. We've got great relationships with our clients. We're very transparent. We have a transparent investment process. We'll be able to sit here in front of you and explain our performance and our insights and how they're coming through in your portfolio. So that's a little bit about what we believe and how we've been successful. I can go through some detail on the investment process, but first if there are any questions, or I can introduce you to the team on the next page, which is page 13. So page 13, as you'll see from the numbers on the page, we have a very experienced team of investment professionals. The firm tenure also is probably unusual. A lot of us have worked together at the firm for many, many years. And that's important, having worked through different market cycles together, and again, had built this investment strategy that really encompasses all of our investment expertise. I think it also speaks to the environment that we work in. We're very collaborative. We work together to achieve our clients' goals. So it is a reason why people tend to stick around a while. I head up the portfolio management team that's on the left-hand side of the page, and they're responsible for the day-to-day implementation of the strategy. Gavin Smith on the right-hand side heads up the research team, and I've explained how important that component is to us. But our teams work very closely together because in order to have successful models and good research, they have to understand what's going on in the markets and the portfolios. So ultimately, Gavin, George Patterson, who's the CIO we report to, and I are responsible for the performance of the portfolios and the evolution of the strategies. But within my group, I'll be working very closely with Steve Courtney and Wen Jin to manage the global growth strategy on a day-to-day basis. Are there any questions regarding the team? So let's turn to page 16. And this is just a little more information on our stock selection model. And the key here is that we're looking for specific characteristics in the companies that we're going to find attractive to add to your portfolio. And they fall into a couple of categories that are listed across the top of the page. So growth. We really want to look for companies, or we're going to evaluate all the companies in our 40,000 stock universe, which about 8,000 of them are in your policy benchmark. And we're going to score them on their growth potential. So do we think that they have good growth potential, and what is the rate of that growth potential compared to other investments that we could choose? We're going to look at things like data that analysts are, sell-side analysts who are following these companies very, very closely. How are they thinking that a company's earnings are going to evolve? We're going to use that natural language processing that I mentioned before to read through the text that we can find on these companies, whether it's from the companies or news in general, to understand how these companies are planning to evolve themselves. We're going to look at components like information momentum. When there are key corporate events in a company, such as a patent or a new product release or a change in management, how is the market reacting to this information as it hits the market? So those are the type of insights we're going to score so that we know what the growth potential of every company is in the universe. We're going to also look at quality. We want to make sure these are high quality companies. We want to be confident that the growth rate of these companies is something that they can achieve. So quality is an important component, especially in a growth portfolio. Linkages is looking at just not at the company itself like these other elements, but how are those companies linked to other companies in the industry. So think about a customer-supplier relationship where you have one company that's supplying another company. That supplier is very dependent on how this company performs. So if there's something really good going on in the key company, the supplier is probably going to do well as well. Similarly, if a company is struggling, their suppliers may get knock-on effects from that as well. So we map out all these different relationships of companies, and not just their customer and suppliers, but how they're related to other companies in the industry to get insights there. And then finally, valuation, which is a little less important for faster growing companies. But if we've got a choice between a couple of investments, we want to make sure that we pick the one that's a little bit more reasonably priced. So all of those elements are calculated every day. There are 260 million elements or data points that we pull in on a given day. And we turn these into these scores for each of these categories: growth, quality, linkages, and value. And then we have enough information to actually analyze the company. So page 17, it's a little bit busy, but if you just focus on the chart in the middle of the page, this is showing you what, again, a lot of what we do goes back to, basic finance and economics. Companies go through growth rate changes. And what we're going to focus on are these rapidly growing stocks that are in the rapid phase of their growth cycle. And when we're evaluating these companies, again, we're not going to use one size fits all and equally weight all the information that we have on them. We're going to focus more on those growth factors that I described. They're fast growing stocks. The growth is what we care about the most. Quality is important, valuation less so, but we're going to make sure the lens we use to analyze that growth stock is mainly from those growth and quality factors. If we look at a more mature company, so these are companies that have pretty stable earning streams, they have their business, not a lot of future growth, there you have to be more price sensitive. So for those companies, we focus more on the valuation factors in determining our final score, our opinion of that stock. Now in a core portfolio, like the one that Kevin had shared the performance on, we're going to have roughly half of the stocks of our portfolio will be rapid growth and half will be mature. And you can think of that like growth and value stocks, and they're balanced in a core portfolio. For this global growth strategy, we're going to be focusing more on buying those rapidly growing companies. So we're not changing anything in how we evaluate these stocks. It's just during portfolio construction, we're going to make sure that we have more of those fast growth stocks in your portfolio. And we do that during the portfolio construction phase. And if you go to page 18, so this is where we take on, it's the left-hand side of the page, the stock score. That's going to be the score that we calculated from all of that data that represents how attractive a company is. And what we're going to try to do is buy as many of those companies and put them in the portfolio as we can. However, we don't want them to be too concentrated in any country or in any industry or any sector. So what our risk model does is make sure that we spread out the stocks that we're buying in those categories and don't have too much concentration in any one area. This is the same area where we'll be constructing the portfolio to have 20% exposure more to those growth stocks than your policy benchmark. And therefore, on the other side, we'll be having less of an exposure to mature companies or the value stocks. So it's an intentional tilt from your policy portfolio towards those faster growing stocks that will be viewed from that growth lens. So a couple other things we consider when we're doing coming up with the final buy and sell list for the portfolio is considering transactions costs. So for a growth portfolio, we do need to turn the portfolio over a little bit more because these companies, they're rapidly growing, information is changing, we have to stay on top of it. The good news is in a diversified strategy, the strategy has about 400 stocks in it, we are really just buying and selling little bits of a lot of different companies. We're not a manager that's concentrated, that has a lot of one stock that we have to be careful about what we trade in the market because we're going to move prices. We're very careful to make sure that if we're going to buy a stock, not only do we expect that we're going to get outperformance from it, but also that we're not going to have to pay a lot in the market to trade it. So we're able to refresh the portfolio on a more regular basis and have very reasonable transactions costs. So that's a model that we have that feeds into this optimization process. And in the end, we get a list of buy and sell recommendations for our portfolio management team to look at. Now, normally, that list is what we're going to go with. We're going to refresh the portfolio, but the portfolio managers will look through this list and make sure that the stocks we're buying or selling make sense and the portfolio's characteristics are moving in a direction that makes sense. So there is a human element on that end of it, just as a double check to make sure from an investment point of view it makes sense. And again, they're very experienced portfolio managers. So any questions so far? I have just a couple of other slides to go through to kind of show you what the portfolio looks like.
I do have one question about the simulation that you prepared for us. You used all these steps, or talk to me just a little bit about the simulation that you did for us to evaluate.
So what we did is we took our existing stock selection model that we use for all of our active strategies. So we didn't make any changes to our opinions of stocks. And when we ran the portfolio, we did the same process that I just mentioned here. The only tweak we made is ensuring that we bought more fast-growing stocks and less mature stocks. So we targeted 20% more growth than a core portfolio. So that was the simple, and you can see that on page 19 a little bit. Maybe that's a better way to kind of explain it in a little bit more detail. Page 19 shows those different factor groups I was telling you about, so that we want, you know, stocks with good growth, good quality, and good value. And what we're measuring it here against is your policy benchmark. So that kind of zero vertical line would be your policy benchmark. So we're overweight, say, good stocks with good growth prospects. What the dark blue line is the exposure of this growth portfolio. What the blue line is the exposure of our core portfolio. So they're using the same stock selection model. It's just in the portfolio construction process, we are adding more or forcing more of the growth into the portfolio. Now, we built this around your policy benchmark. And you might think, well, why didn't you just use the growth benchmark? Because that would have been a lot easier. And actually, if you look on page 22, when we look at the All Country World Index, and then look at the growth version of that index on page 22, if you look at the left-hand side of the page, you'll see that a lot of that benchmark is concentrated in information technology. So over 38% of that benchmark is in information technology, whereas in your portfolio, in your policy portfolio, it's only 22% in your policy benchmark. So what we did was, instead of using that growth benchmark, we started with your policy benchmark and then included those additional fast-growing companies, so that we're getting opportunities for fast-growing companies more evenly across all of these sectors and not just from technology. If you look at the top 10 positions on the right-hand side of the page, to me, that kind of hones in a little bit more on the concentration risk of the growth index. Over 41% of the index is comprised of the top 10 names in that benchmark. So again, to not be as concentrated in just, you know, these high-tech mega cap names, we're using the ACWI IMI, which also has exposure to those names, but it's not as concentrated.
Just want to make sure we answered your question sufficiently.
Sure, you
Yep.
have. You've told me what you did. I'm saving my question, how much money do we make, till later? No, but, no, y'all continue. You do what-
Stacy's last comment is a very key point, because through our research and the testing that we've done, is we can build a growth portfolio that has those very distinct growth characteristics without taking on that market concentration exposure that you might be exposed to by building a portfolio versus that growth benchmark. So in some ways, you're getting your cake and eating it too. It's the best of both worlds.
Did I miss the part about risk? Or can you elaborate on that? I may have missed that in depth. I don't hear so well, so if you would talk a little bit.
Yeah,
about that.
actually, there's a couple of pages in the appendix, page 28 and 29, that give you a good sense of how we're keeping risk tight when it comes to sectors and country risk as examples. So when we put the portfolio together, we are going to buy all of these high-ranking stocks from our stock selection model, but we're making sure that we don't have too much concentration in any sector or industry. So on page 28, you'll see we are, over or underweight relative to your policy benchmark in different sectors, but it's never really more than about 3.5%. There's sometimes a little drift in there. When it comes to countries, there we're going to keep it within about 2%. So we're not going to come to you with a huge overweight in China or a huge underweight in the US. We give ourselves a little bit of wiggle room to make sure that we can get the good investment opportunities, but we're really going to keep that country and sector risk pretty tight or under control. So our excess return is coming up from the fact that the stocks we're putting in your portfolio are really good, fast-growing stocks with good quality, but they are diversified across the world and through different sectors.
It's a highly diversified portfolio. So as of the end of the year, actually the end of March, the portfolio would have had 388 holdings. So highly diversified by name. As Stacy mentioned, highly diversified by country. We're not taking big active over or underweights by country. Same thing by sector. So we want to neutralize exposure to all those things, like taking big concentrated positions in country, sector, individual stock. And we're going to lean into these alpha factors that we compute on a daily basis, growth, value, quality linkages, and build a portfolio that's highly diversified, that provides exposure to those factors that we're calculating day in, day out.
Now, you've got a few more minutes. If there's something burning that you want to speak to, go right ahead.
You may have something burning.
I think we've hit all the key points. We want to be respectful of your time. We're 5 minutes shy of the segment that you've given us. So I have a couple.
That's the reason
Nope.
I want you to get it all out there
We're good.
before I turn them loose on you on questions. So,
Please, any questions that you have.
okay. Board or other
I know
folks?
you've mentioned it and I just missed it. Where are you all headquartered?
In Newark, New Jersey. So our entire investment team is actually on the same floor with the researchers, portfolio managers, traders. We're all in one floor in Newark, New Jersey.
In New York City?
Newark, New Jersey.
It's
Yeah.
right
By the
outside of New York
airport.
City. Yeah, so Prudential, The Rock is headquartered,
You get-
founded
you
in
get-
Newark, New Jersey.
North of West Virginia, they're all the same.
I went to West Virginia University.
did. That's all.
I know that for sure.
You didn't go to Rutgers, though.
I did.
Stacy did, yeah.
John?
Yeah, just a brief question. Can you talk about, I guess, expected underperformance? So you've got the three-factor model and where, talk a little bit about those periods or market events that will lead to underperformance.
Because this is a growth portfolio and we are comparing ourselves to your policy benchmark, we are going to struggle in times when value is doing really well. So as a growth portfolio, we do have some value elements, but we're really focused on growth. There are periods where there's a lot of turmoil in the market, as there is now, and there's a lot of emotion driving prices and not fundamentals. I talked in the beginning about how we focused on fundamentals. And so we may temporarily not do well when there's a bit of chaos in the market. But what that's doing is it's pushing prices away from fundamentals. And that gives us opportunity if we stick to our philosophy, which we do, and stick to our systematic investment approach, we'll ultimately capitalize on the fact that there were those temporary price deviations. So I think those would be the two periods.
Thank you.
Got any other questions?
No, I just wanted to add that that's not too unlike what we do when we stick to our asset allocation strategy. You know, as long as we maintain the course and don't let, macro events push us around, over time, it tends to work. So.
Yes.
Am I misremembering here that this looks more like an international growth fund than it does a global, even though technically it's a global because of the US being in there? But many times there's global strategies we've got and they're driven by US pieces. Is that right? I mean, depending on how much weight. And obviously, the country weight in this
I'll
one is
let you
very,
speak to that, but that's, go.
Yeah, so the global benchmark, 65% of that benchmark at the moment is US. And there are a lot of great growth opportunities in the US. So that's an important part to place to invest as a growth manager. There's also, developed markets around the world and emerging markets around the world. And emerging markets are another great place to find good growth opportunities. So the portfolio will have investments in all of those countries, very similar to the policy benchmark. But we'll be able to find growth in all of those areas and not need to tilt too much towards one country.
right, because it's all within that, a pretty tight
Right.
piece of sector and especially country, being
Right.
that 2% or 3% or so,
Right.
is as heavy as it gets,
Yeah,
expected to
and
be.
that's going to include the US, it's going to include Europe, Asia, worldwide opportunities.
Thank you.
Like specifically page 29, far right-hand side of the page, that table, there are a lot of small numbers on here because we had to fit every country that's in the benchmark on that page, on page 29. The middle column, you'll see all the countries that are included in your policy benchmark. And when we're building the portfolio, we're building it relative to the weight in that policy benchmark. And we have certain limits around the amount we can overweight or underweight each of those countries. So this absolutely is a global portfolio. And we want to have representation across all those countries within a pretty tight limit just to control risk from a portfolio construction standpoint.
So that's 2.5% plus or minus.
Right.
Was one of the things that drew me to the portfolio is that they don't let their attribution in, macro bets in countries or sectors, push their returns. It's stock selection. So,
So you say you have a universe of about 40,000, and how many of those continually bubble to the top? I mean that, share that with me. You know what I'm trying to get to.
Right.
Yeah.
So 40,000 is everything across the world from the most mega cap down to micro cap. So that was just to impress you with our quantitative abilities.
Yeah.
Your portfolio, your benchmark has 8,400 stocks in it at the moment. So that's our universe we're evaluating for this global growth strategy. And typically we will choose anywhere between maybe like 400 to 550 stocks out of that universe. So very diversified, but we have a lot of good opportunities there. And there will be a rotation of those stocks. The really tiny ones that are hard to trade in emerging markets, we probably will stay away from them because the cost isn't worth it, and we can find growth opportunities better and elsewhere. But for the most part, that's the universe we can choose from, and then we narrow it down to the 400 or so stocks. But that's the beauty in my mind of a quantitative process, is nothing is off the table. And if it meets our criteria and it's a good investment and it fits into our risk framework, it's eligible to be in the portfolio.
I was just trying to figure out how you look at 40,000 every day.
I know, there's a lot of good computing power out there. And I think that's, again, a quant advantage, is that we can look at all of this information. And we have a team of technology people that sit on the floor with us, just dedicated to the investment team. And their job is to collect all that data every day and make sure it gets to us. And we have sophisticated software that highlights for my team what data looks funny today. And then we have analysts that dive into it so that before the market opens, we know we're working with good data. We know that we've updated our opinions on all of these stocks and we're ready to go.
Did you all address the turnover of your stock? Did I missed that, or
Yes.
tell it to me again?
Yeah, so for a typical core portfolio, we turn the portfolio over about 100 to 120% a year. For a growth strategy, we have to turn it over more frequently because the growth stocks fundamentals are changing faster. So we have to keep up with that information. So that's more around 200% a year. That sounds like a huge number, but in reality, what we're doing is just buying and selling little pieces of different companies. So we don't have big blocks of, a stock that we're trying to unload because all of our clients have big positions in it. Instead, we're just buying and selling little pieces, so we're not moving the market with our trades. So that's a big focus of our kind of risk control and deciding what's going to be in the portfolio, is making sure that if we like something today and don't like it tomorrow, that we can sell it without having a big price impact.
So how do you do that and remain obscure?
So we are careful about how much of the daily volume of a stock we trade. So if a stock, trades a certain amount of shares a day, we want to make sure that we are just a fraction of that so we can unload it quickly, if need be. And when we're actually deciding what to buy, we have a transactions cost model that will predict what it would cost to sell this stock. So we don't even buy it if we think it's illiquid and would be difficult to sell. Did that answer your
Yes,
question?
absolutely.
In your model, is it easier to determine what to buy or what to sell?
It's equally easy because there's no emotion in it. The calculation's the calculation. So it's not like we bought something yesterday and I'm like, oh, no, I know that stock's going to come back. Like, there's none of that. It's purely mathematical, which makes it easy to do it on either end.
Okay. Other questions? Questions from the board? Well, Stacy, we want to thank y'all for coming. And just so you'll know, my ancestors went through West Virginia on the way to Mississippi, but that didn't slow down. So
Fantastic.
just
We'll have to
so you'll
compare
know.
notes.
We appreciate y'all coming and sharing with the board and looking forward to a long time with you all. So thank y'all so much. We've got a little bit more business we need to take care of here.
It's really our pleasure. Thank you
Thank
so
you.
much.
right.
Really appreciate your time today.
Absolutely. Thank you.
Thanks so much. Take care.
Kevin, have a good day. Okay, I think we're at the point now where we would turn it over to you. And once again, if you'd tell us the recommendation of staff.
Yes, sir. It is the recommendation of staff that we contract with PGIM to replace Epic as our global equity, global tilt manager.
Okay, we have heard the motion. Can I have that as a form of a motion from a board member?
So moved.
We have a motion. Second?
Second.
We have a motion and a second. Any further discussion now?
Are they contracted with other similar states in our region?
They do work with other pension systems, but I'm not sure if they're in our region, that I'm not aware of.
And what they're going to do had been being done by whom?
What they're going to do for us, they created this for us.
So they're not
It's-
replacing anybody.
Well, they're replacing an asset manager that's currently in place that has been having performance, issues in relation to benchmark and peer groups. So this is to replace that portfolio, which was Epic.
They do this for other organizations, other pensions, whatever, about $114 billion worth, similar to this. but I feel sure they build specific things for each one of those.
They do, from time to time, when needs are there, they will, build, for specific needs, yes.
Other questions?
Did you say that the financial commitment of cost has not been negotiated yet?
They offered about 6 basis points, roughly 6 basis points to manage this, which is a significant savings in what we're currently paying.
Other comments or questions? I'm gonna call for the vote. All in favor say aye. Aye. Any opposed? There being none, staff's recommendation is approved.
Thank you, sir.
We, I believe we're at a time that we need to break for lunch, and then when we come back at 1 o'clock, that'll give us about 45 minutes. Then we have our non-US fixed income manager presentations.
Yes, sir.
Okay, is that about the right time for them?
Sounds good, yes. Yeah,
Okay.
they should be coming in
Very good.
soon.
Well, then we're gonna call a recess until we finish lunch. Thank y'all.
We have a
We're sorry, your conference is ending now. Please hang up.
because his folks came to vote.
It was crazy.
Because they were the antis and the true believers. They came to vote, so he got every vote he is gonna get.
Who's that, Todd?
Chambers.
Oh, Chambers, yeah.
But he is grossly incompetent.
Unfortunately, it appears he has his mama's traits and not his daddy's and uncle's.
Requirements of what they do daily basis, and it just kills me.
Well, I know that
Well, good to
God, it is happening.
Yes, sir. How you doing today, sir? John, good to see you.
Miss Hannah, good to see you.
Good to see
Still the
you.
rose amongst a bunch of thorns, aren't you?
Good to see you. How are you, sir? Good to see you. Red
Back them all
lights
up
are
to them.
worse.
Had to apologize.
That's your
This
worst
week?
Yeah, night
piece of it.
before the election, I know.
But,
Is
but
their
the
conference
first
down there as
primary
well
was
right now, or
on,
they just,
he
maybe
said
on the
his polls
PDD?
indicated he
This will be the first time I've been to the PDDs.
and she,
New teacher,
Coach John lost it.
basically, 2 years probation. You can just
Nobody heard
fire
about
them at will. You just leave their name off the list and
Tammy, is
write them a
Tommy
letter and
Robertson
say,
back on the code?
That may have been what it was.
we have not Even though I wouldn't mind. It is 1 o'clock. It is time for us to resume the investment committee meeting. Turn it over to you, sir.
Mr.
Sorry.
Chairman, thank you. I hope you enjoyed your lunch. I have here with me David DeGuire. He oversees our fixed income portfolios, both public and private. We're, in necessity, we need to make a slight change to the presenting schedule due to logistics. Instead of PIMCO going first, it'll be AB. But with that, and also we will be having an individual from Wellington call in to cover that portfolio. With that, I'll hand it over to Mr. DeGuire to.
Thank you. Thank you. Can you hear me? All right, so today is going to be the global and emerging market portions of the fixed income portfolio. Each one of the three managers that are presenting today represent about 10% of the fixed income portfolio. Fixed income portfolio overall can fluctuate 18 to 20% of the portfolio generally. So each one of them represents about 2% of the overall portfolio. The teams here are absolutely top-notch in fixed income. The last peer data that I had, every one of these managers put our fixed income portfolio in the top decile for similar plans of our size. And that's probably as of second half of last year. So each one of these will, the first two, AB is a global manager as well as PIMCO. These are dollar hedged portfolios. And then Wellington, the third one, will be your emerging market debt portfolio. I do want to say this, from quarter to quarter, there can be, relative to the benchmark, some underperformance or overperformance specific to China. We've made the decision to have an underweight allocation to China in each one of these three portfolios for very specific reasons. But we won't get into today. But so you may hear some managers talk about some underperformance relative to our underweight in China, which is okay. The previous quarter, it was a benefit to us that we were underweight China. So it just fluctuates from quarter to quarter. So that being said, if y'all have any questions for me, I'll grab, if you don't, I'll grab AB to start off with. And we'll get things going.
Okay, let's go.
Chairman?
Yes, sir. Thank you.
Charles. This is the one that moved from New York to Nashville.
That's right.
They used to be in New York and they moved to Nashville.
I think that's right.
I can't remember. It's been, what?
Good afternoon, everyone.
Good afternoon.
How you all doing?
Good afternoon.
Does everyone have a good lunch?
We did.
The rain stopped, the sun's out, it's gonna be a great day.
Okay, thank you for coming, and we're gonna turn it over to you.
Thank you. My name is Amanda Dunn. I am the relationship manager. Had the pleasure of working with all of you. Thanks for having us in today to talk about your global bond portfolio. I'm joined by my colleague, senior investment strategist, AJ Rivers. AJ comes out of our Nashville headquarters. And so if you haven't been to our office yet, I encourage you to come. We'd love to have you in. The intent of our presentation today is just to give you a quick update on AllianceBernstein. We'll take you through the performance of your portfolio, talk about some of the characteristics, the positioning, and we can talk about our outlook as well. I know John presented earlier talking about the dynamics between the US and the non-US. Certainly there's a lot going on. So we'd be happy to take any questions that you have, and we'll take it from there. So if you'd like to turn to page 1, I know we've worked together since 2013, but AB assets under management is roughly around $800 billion. Of that amount, $296 billion is invested in our fixed income strategies. Global Bond, the strategy that we're here to talk about today, has roughly $85 billion in assets under management. The portfolio that we manage for you all is roughly $800 billion in assets under management as of the end of March. Million.
We wish it was billion.
We'd happily take billion, but million, yes, thank you, AJ. AJ, I'll turn it over to you to go through.
Sure. Good afternoon, everyone. Thanks for having me. I'll just start by saying I'm a fixed income nerd, so if I say anything that...
AJ, would you turn that microphone toward, thank you.
Can you hear me better now?
That's good, thanks.
Oh, geez, okay. So I'm a fixed income expert. If I actually say anything that kind of goes over your head, just feel free to stop me, ask any questions along the way. So if you turn to page 4 in the pitch book, I just want to give you a quick reminder of what this strategy is. It is a global multi-sector strategy. And if you look off into the pie on the right, there's essentially 3 primary ways that we can add value in this portfolio as an active manager. It's going to be through the yield curve or the countries that we select. It's going to be through sector rotation, the various components of the fixed income universe that we can choose from, as well as security selection, the individual bonds that we can buy within that strategy. And then currency can have a very small contribution to excess returns as well. It is a currency hedge strategy, so we won't take many currency bets in this portfolio. And if they do, they have to be very high conviction and meet both our economic, quantitative, and fundamental screens to do so. And if you do see slippage, sometimes there is just a timing effect of the strategy. That said, I think it is a timely discussion because this is a strategy today that we are highly recommending to many of our clients outside of this. So certainly something that you may want to consider increasing an allocation to. Largely that's because global bond portfolios tend to deliver you a similar return to core bond mandates. They just happen to come with less volatility because there's a lot more diversification that you can get across the globe, for lack of a better word. And in the current environment, kind of good luck really kind of getting a sense of what's going to happen to the US yield curve. There's a lot of volatility associated with policy uncertainty that we can kind of dig into a little bit, where there is a lot more higher conviction strategies that you can take offshore. So we would actually expect you to get better than core returns in a strategy like this, but also come with less volatility than you usually would. And that's kind of how this strategy is positioned. So I'll skip over to slide 6. Over the long term, we've done a pretty good job of delivering excess returns. Granted, those have not fallen within the excess return hurdle that you saw on slide 4. We can blame a lot of that from what happened over the course of 2022 and to some degree earlier on in 2020. But we have done a decent job, and sort of performance as of late has been pretty good at the strategy level. If I know we're here to really cover the 1 year and the 1 quarter, and I'll talk about that. But you can see sort of those have somewhat offset each other. The 1 year return, we underperformed the benchmark by 47 basis points, and on the 1 quarter, we had outperformed by 40 basis points. There is some level of noise associated with that. This strategy restricts direct China exposure in the portfolio, and it is 10% of the benchmark. So it can create a lot of noise and excess returns relative to this benchmark. So agnostic of that, we still think we're doing a relatively good job, but I'll just give you a sense of what that looks like. And I'm sorry, I'm going to skip forward and then come back. But if you start at slide 10, kind of what happened over this time period that we're evaluating. The story was pretty much both rates and credit driven. So if you look at the left-hand chart, you can see that most of the G7 yield curves actually gradually drifted higher over the course of the year. And there's this inverse relationship between yields and bond returns. When yields go up, bond prices go down. And so the end result is that most of the places that we've taken exposure had earned you slightly less than the yield to worst or the income return that you would get on the portfolio because there was a modest slippage in price. Now, if you look at that large bar on top, China, that was one of the largest outperformers from an interest rate perspective on a global scale throughout 2024. It's going back to that inverse relationship. When yields fall, bond prices increase pretty significantly. Over the third and fourth quarter, there was concerns over China growth and that they would not be able to meet their 5% growth hurdle. That would be accompanied with monetary and fiscal stimulus, which means yield curves would come down. That's exactly what happened. And so China bonds rallied pretty significantly. And again, not having that exposure in the portfolio, you do the math, 13% times 10% in your portfolio is automatically about 1.3% in slippage. So if you skip off to slide 11 and you look at the right-hand chart, which I would prefer to look at from a credit perspective, that kind of points to what happened over the course of the year in credit. So unlike interest rates that gradually increased throughout the year, credit spreads for the most part grinded tighter throughout the year. So they started at a higher level and then eventually came down. When credit spreads compress, you get, similar to when yields fall, you get a positive absolute return experience. And in November, you had credit spreads hit all-time tights historically. And that means that credit spreads had reached a level that had never been seen before. You had very, very strong positive excess returns in credit markets. So you can see things that are very credit sensitive, like European high yield, emerging markets, high yield, subordinated financials. They all did incredibly well. The higher quality bonds did not do as well. So the key to winning last year was sort of a combination through a shorter duration and a higher credit quality bias. Now, if you skip back to Q1, which is going to start on slide, oh, sorry, I didn't get you to the attribution. So on slide 12, kind of walking through what I had just described, we had underperformed from an interest rate perspective. That largely is due to that China exposure that I had just talked about. The 13 times 10% equals roughly 1.3%. Not shockingly, that was kind of the underperformance there. And then the rest of our excess return was driven by credit through sector rotation and security selection. That's 63 basis points in the aquamarine or teal colored box, largely comes from corporate bond exposure where we're able to add alpha through individual bond selection. So going back to slide 7, everything that I had just talked about has kind of reversed over the first quarter, right? So rather than interest rates kind of backing up and credit spreads tightening, you had the opposite effect, right? So you had, generally speaking, interest rates coming down throughout the course of the first quarter, where credit spreads started to back up sort of on global growth concerns. There's probably one exception to that, which was Europe, and that's why you see a bunch of these blue bars down in Europe off to the left underperforming. Germany in February had announced a very strong fiscal stimulus package, which led to a significant increase in the sovereign yield curves, and that caused an increase in yields across pan-Europe, which caused those sort of to underperform on that perspective. And then again, if you look on slide 8, you can see sort of the reverse is true from a credit perspective. Again, if you look off to the golden bars on the right, you can see that credit spreads started to slip a little bit wider. And then again, the more credit sensitive sectors had underperformed, with again, the exception of pan-European high yield, which was on the back of that German fiscal stimulus. Okay. So therefore, over the quarter, and China was a net beneficiary because you saw the opposite happen with China. You saw China yields actually start to increase, and your underweight exposure there added a lot of value. So go to the attribution page on slide 9, and you can see that, pretty much the opposite of what you had saw, with the one exception being that security selection was still quite positive in the corporate bond sleeves. So I'm going to skip down a little bit through this macro section because I'm assuming you're going to have a lot of questions on that front, and we can save time to address those in a minute. But I'll just skip down to slide 32, and I'll give you a minute to get there. So if you look at the top, you can see that agency MBS is a sector that we've been somewhat overweight. We have maintained a higher quality bias in this portfolio. So as credit spreads started to grind tighter throughout the year, we started to peel back some of that risk, the old concept of buy low, sell high, right? So that's something that we wanted to implement in your portfolio. And so we started to migrate the portfolio towards higher quality instruments like agency MBS and CLOs. Now, I would say agency MBS has served its purpose where we were able to maintain this higher quality, more liquid exposure, but also get you incremental returns above pure government bonds. Now that credit spreads have widened pretty significantly post Liberation Day, I would expect to see that part of the portfolio start to come down and have us reallocate to places like investment grade corporate bonds, as well as that CLO bucket would probably increase because you've seen securitized spreads blow out. Just as a way of example, for AAA CLOs, you can get about 150 basis points over US Treasuries of a similar duration at a AAA level exposure. That's a very attractive place to kind of park some of that higher quality bucket. And I would also expect to see us potentially rotating a little bit more into high yield. And you should see that kind of bucket start to increase. You saw some of that increase over the quarter as spreads did widen throughout the quarter, but they widened pretty significantly over the month of April. That certainly presents an attractive buying opportunity for us in this portfolio, as well as in broader multi-asset portfolios as well. Some of the other things that I just want to touch on, CRTs, you'd see that exposure probably remain relatively static. Well, it's something that we really like in the portfolio. Again, those are credit risk transfer securities that are effectively U.S. residential mortgage securities that are packaged up into broader securities. And that is a space that we were pretty happy to add to portfolios over the course of 2022, 2023. That's something that you'd probably just see slowly amortize down as those bonds start to pay off. It's not something that we're going to sell. It's not something that we're going to add to either. Other kind of things to point to is that EM bucket, right? You saw some of that come down over the course of the quarter. I would expect that to come down just a little bit more as we can actually swap out of the EM exposure and buy just generic US high yield at very attractive levels. So those are some changes in the portfolio that you'd potentially want to look out for. On slide 33, I'll touch on these exposures just a little bit. Banking is one of the largest overweights in the portfolio. I would expect us to maintain that overweight. Generally speaking, banks have what we call a beta type spread. So they kind of move in line with the index and historically trade underneath the index values. So, and today you're getting about a 20 to 30 basis point spread pickup to own some of these high quality national banks. And so we see that as a very attractive opportunity, and it's added a lot of value in the portfolio over the last year and quarter, as you can see from security selection. In the consumer cyclical space, that's probably an area where you might have questions. Why would you want to be overexposed to an area that could be potentially softening on growth concerns? I would say that's largely driven by autos, and we've been sort of overweight predominantly two names in that space, which are Ford and General Motors. We think that these are companies that are going to be somewhat insulated to the trade-related issues that you see happening in the auto sector, but have seen their spreads widen pretty significantly alongside the auto sector. So for us, that's an attractive buy. And then energy, you're going to see most of that exposure going to be in midstream and downstream, so places that make money off of the spread that's associated with refined oil products or the delivery of those products, not necessarily tagged to the cost of production of oil like E&P. So we don't really have concerns about falling oil prices as of late to our exposure in the energy sector. I will skip over to slide 34 for now, just to give you some basic statistics on the portfolio. Given our kind of credit quality composition and spread composition, if you look at yield to worst and OAS, these are places where we continue to get you excess income over the benchmark. I would expect that to continue given the way we're positioned in the portfolio, especially since we're adding to some risk here on spread widening. I would expect to see those numbers tick up slightly by the time you have your next quarterly review or someone comes in here to speak to it. On the duration perspective, we're somewhat neutral. It's a little bit noisy. It looks like we're about 1/10 of a year short the benchmark on an effective duration basis. But I would just say that a lot of that is driven through exposure to multiple curves, as well as that China underweight. We would have to take duration overweights at greater levels than we would want to in certain countries to replace that. So it's also not a huge underweight. So certainly not something that I would say is a huge active bet in the portfolio outside of country exposure. What am I missing?
Coming up on time.
Are we? Okay. Sorry. We're long-winded, those fixed income guys. So slide 35 is pretty much there to answer any question that you might have, but essentially our view is not far from consensus, right? If you think about where we've come from versus where we are now versus where we're headed, you kind of have a place where the economy was quite strong, right? GDP growth has been pretty healthy. You see the employment market pretty stable at what we call equilibrium, meaning we're adding about as many jobs a month as we can to keep the unemployment rate stable. And, by all measures, the Fed and most central banks had sort of won the battle with inflation. Sort of where we are now, we expect that to kind of continue over the next quarter or two, but the related uncertainty over tariffs, as well as the sting to consumer and businesses from both a cost and policy uncertainty perspective, are likely to drive inflation higher and growth slower in the near term. We're not predicting a recession per se, but we have probably about a 50% probability of growth falling below zero. And we do expect unemployment to increase to about 5%. So that means a lot of the active risks that we're going to be taking in the portfolio are going to be on a duration perspective, right? But it's going to be largely outside of the United States, where we have higher conviction on where both yields will trade and where growth will fall. So places like the EU are going to certainly see growth deteriorate if you see less consumption from imports from the United States. That means that those yield curves are likely to fall, and you'll see some benefit from being overweight duration there. Same goes for the UK. And Canada was a place where we had that exposure and are starting to collapse that position as we've seen sort of the excess returns that we would have expected. Outside of that, we're going to be sort of periodic or marginal buyers of credit risk. There are certain areas that we expect to deteriorate faster than others. So places like in corporate credit, I would say, tech and consumer discretionary are one of them, right? As consumers start to peel back from the higher cost of tariffs, you would expect companies that are sort of in that experience spending category to have pressure on margins, which will cause credit spreads to widen. And tech sectors are really trying to figure out how they're going to re-engineer their global supply chains. And so we do see cash flows being somewhat compressed there, and that's going to put pressure on spreads as well. So we will be buyers of that if and when the opportunity presents itself. But for the most part, we are really just buying beta when we see spreads widen out in the more defensive sectors currently. Are there any questions? I know I've probably gone over time now.
Quick question. The employment trends continue to be positive, but the economic trends are a little iffy.
Correct.
That doesn't match.
So unemployment is what you would call a lagging economic indicator. It really tells you sort of where the economy is coming from, not necessarily where it's going. By all measures, that's been pretty healthy. You did see about a 1% increase in unemployment over the last 2 years, from a bottom of 3.4% to about 4.2%. Most of that was driven by an increase in the working force population, not necessarily companies not hiring at the same rate. But you did see hiring fall from post-pandemic level peaks of about 800,000 jobs per month to slightly under about 150,000 on average. Last month was a very strong print at 228. But essentially, like right now, the labor market is what we call an equilibrium. It means that the number of jobs that are being added per month are just enough to offset the increase in the workforce, which keeps the unemployment rate stable. If it gets put at risk, you would expect to see hiring slow and potential layoffs happen, which would push the unemployment rate up in the future. And when you look at future conditions, there's actually a slide on this in the deck. See if you can find the consumer sentiment slide in the middle. I'll point to that in a second. But essentially what you have is, ISM, Conference Board, Michigan. These are all survey measures of where consumers and businesses expect the economy to be headed. And those measures have just fallen precipitously. You've just seen the biggest drop off in the Conference Board and Michigan surveys in consumer sentiment. And that was pre-Liberation Day. I would expect that post-Liberation Day, once you've seen the majority of households watch their 401ks decline, that you'll see that come down. You're going to see those prints get released on Friday as well as Wednesday of next week. And those will be pretty telling on where the consumers at least think the economy is headed. I think most of you know this, but consumer spending accounts for 70% of real GDP growth. If the consumer starts peeling back even just modestly, that can have a significant drag on growth. The other thing is, if you have an initial price increase from tariffs, which are inflationary, that means the marginal dollar that folks are going to spend is going to be lower, right? Because they have to spend more money on the things that they were already purchasing. And that causes consumers to clamp down and actually save more. And so even if they just kept spending the same, you would still see real GDP growth fall because inflation is simply higher, right? So that is one element to it. The other is on the business spending side of the equation. Businesses are having a hard time figuring out what the final implementation of the trade policy will be. That makes it very difficult to figure out where they're going to spend CapEx. And CapEx is, counts for about 15% of economic growth. So money spent in addition to operating expenditures to drive innovation and growth in their businesses. If they're not really certain where or how to spend that money, then they'll peel back in discretionary spending as well. And you see that also reflected in the Purchasing Manager Index surveys. And there's going to be another update on that this week as well. So, bottom line is if there's any sort of resolution or final implementation to the policy that will help reduce economic uncertainty, which should drive spending further, but certainly expect that for the next couple of quarters, growth will slow because essentially, businesses don't know where to spend money and consumers are scared.
Do we have questions from the board or from our consultants? So what was your prediction about the tariffs?
My prediction about the tariffs?
Yeah, I mean, it seems to me what you're doing, could get hurt coming and going. Either way, or we could win coming and going, so.
So I would say, as far as you're invested, you probably have one of the best investment strategies from a global fixed income perspective to kind of weather that storm. Because when growth slows, you expect that duration will rally, and this is a sort of a duration type product. That also just creates a massive amount of opportunity from a credit perspective as dislocations drive alpha. So when it comes to how you're invested today, I can't think of a better fixed income strategy to have in a portfolio. It will certainly take advantage of all of the tariff-related policies. But on net, from an inflationary perspective, right, like people are like, why do tariffs drive inflation? Well, a couple reasons, right? You have the initial price shock from the tariff itself, because it's just like stamping a 20% tax on something, right? You also have the incremental cost of reconstituting global supply chains, which can be very expensive, especially if you're a company like Apple that makes most of your phones in China. You also have the loss of comparative advantages, where it's just simply cheaper to produce something somewhere else, right? So I would think of that trade-off as going to generally create higher structural inflation. It's no different than like if one of you was an accountant and one of you was an attorney, you'd probably want to trade off and have the accountant do all the accounting work and the attorney do all the attorney work, because you're going to do that work far more efficiently than if you both tried to do both. That's the economic concept of comparative advantage. Those get eroded when you force the accountant to do the attorney work. So that will create inflationary pressures, but those will also fall as demand gets suppressed, right? So one of the things, another economic principle is that prices rise when demand increases, right? Because demand is in excess of supply. When you see growth soften, you will see inflation start to come down because you won't have enough demand to support the supply that's out there. So you have that short-term impact of that. From the growth side, it's everything that we talked about, right? So if the consumers already are peeling back, that's going to be a drag on economic growth, as will business investment. Those two categories alone account for 85% of GDP growth. The other 15 is fiscal spending, which we're actually going the other way around, right? So you see some level of austerity in Washington today, where we're trying to reduce expenditures. Rightfully so, but that's not going to be a net contributor to economic growth. So you have to look to businesses and consumers to fill that gap. And again, you've already started to see a significant shift in consumer spending patterns away from discretionary and experience spending and post-pandemic related excess spending towards more conservative essential spending. And with that, you've just seen the largest drop off in consumer sentiment. And it's pretty easy for consumers to just say, hey, you know what, we're not going to go to that restaurant this week. Or, you know what, we're not going to take that family vacation. Or, you know what, why don't you trade down and buy the hamburgers instead of the steak, right? So as consumers start to make those types of decisions, that can easily drag on the economy. And if businesses think that consumers are going to spend less, that's going to reduce their top line growth at the same time that tariffs have just had a significant reduction in their operating margins, because the cost of doing business has just increased significantly. So they're likely to spend less money on CapEx outside of reconstituting global supply chains. So that will cause, that's why most economists are calling for a reduction in economic growth.
Okay. Any other questions? If not, AJ, Amanda, thank y'all for coming, unless you have something else you want to share.
Thank you
Something
for the
burning.
trusted partnership,
Thank you.
and please let us know if we can be helpful in any way.
Yeah, and I would just say that, over the last 3 years, expected fixed income returns have increased substantially. We see a lot of your counterparts increasing fixed income allocations to immunize some of the liabilities from their pension plans. Good time to consider adding. That's it.
Okay, thank you.
Thank you all. The restaurant analogy has not hit Mississippi yet. You can't get in.
What was that?
Have you eaten out lately, or are you too tight to go?
Well, I live in Clinton, so relatively I'm too tight to go, right? I mean, but, yeah, when you go, I haven't seen a diminished crowd yet.
Lead man there. Commissioner, that's the pot calling the kettle black.
I'm not tight, I'm just thrifty, thrifty,
At least.
thrifty.
Thrifty, because cheap just sounds so negative,
Our guy was,
even though it's appropriate.
Very.
Apologies.
our guy was pretty big on Liberation Day. I don't know if he was derogatorily using Liberation Day or,
Wait, no, Bill, what did he?
I caught
I
that.
thought it felt a little flattering. He didn't say it and then spit on the ground. He just said it.
Bill,
I started to ask him, but he was,
what did he mean by
adamant
that?
about
Liberation Day. Huh?
He referred.
that's right. Yeah,
I'm not sure.
otherwise he would have called Liberation.
Charles, this will be PIMCO now?
Yes, sir.
Okay.
They should be on their way in. And the representatives there will be Chloe, Kelly, Eric Bachman, and Sachin Gupta.
I remember Chloe, she's the one who's always bragging about Georgia and their football. Oh, I apologize for that.
Not again.
I haven't even said anything.
And our baseball team's good this year.
They are.
Howdy toddy.
We thank y'all so much for being here. Chloe, I guess we'll turn it over to you to begin with, maybe?
Yes, sir, thank you. Well, good afternoon. We really appreciate the opportunity to be here. It's wonderful to see you all on this rainy day. I see many familiar faces, but for those I haven't met yet, my name is Chloe Kelly, and I'm an account manager in PIMCO's New York office, where I work exclusively with public plans like PERS of Mississippi. I'm joined today by my colleague Eric Bachman on the far right, who is also a member of our public plan team. Eric and I work very closely together on all things PERS at PIMCO. And we're also delighted to be here with Sachin Gupta, who many of you know. Sachin is a managing director, head of our global desk based out of Newport Beach in PIMCO. And he is most importantly the lead portfolio manager for the PERS of Mississippi global portfolio. We, on behalf of PIMCO, just want to say thank you all for the longtime partnership. This year marks 42 years of the partnership between PERS of Mississippi and PIMCO, and so we just want to say thank you. We really do appreciate the trust and confidence that you have placed in us over the years. I understand we have about 20 minutes with y'all today, is that right? Okay, so during that time, I'll just give a brief update on the firm. Eric will talk a bit about performance, and then we'll spend most of the time with Sachin talking about what's going on in markets and what that means for your portfolio. We'll certainly leave time for questions, but please feel free to stop us throughout if there's anything on your mind or that you have questions about. Before we start, is there any particular topics you want to make sure that we cover outside of what you've already shared with us? If not, we can go ahead and get started. I'll start on page 5 of the materials that you have. Here you have a brief snapshot of PIMCO as of December 31st. We did just get in the March 31st numbers, so I'll give you a quick update there. Assets under management at the end of March were just over $2 trillion, so that was up 4% from December. The firm overall remains strong and stable. We continue to add experienced resources. We have over 270 portfolio managers with an average of 17 years of experience. That's in addition to the 85 credit research analysts that we have with an average of 16 years of experience. There are no significant organizational updates to report to you, but I'm very pleased to share with you that we have added Janet Yellen, who's a former chair of the U.S. Federal Reserve and former U.S. Treasury Secretary, to our Global Advisory Board. Ms. Yellen will join a renowned group of global experts who help us inform our views, further refine what we're thinking, challenge our beliefs, and importantly, all of that is focused on ensuring that we can continue to generate long-term consistent outperformance for our clients. So I'll stop there and I'll turn it to Eric to talk about performance of the global portfolio.
Great. So if you can turn to page 10. Since we were in front of the board 2 years ago, the strategy has returned 4.7% on an annualized basis, outperforming the benchmark by 33 basis points over the last couple of years. Over the long term, the strategy has outperformed on a 5-year basis at 114 basis points. And since inception in 2013, 59 basis points on an annualized basis as well. So amid the volatility that we've seen in April, this strategy is essentially flat through yesterday, which is in line with the global benchmark. And this really just demonstrates the importance of having global bonds in the portfolio and the value of diversification, as we've seen a broad index of US bonds selling off 1.3% month to date. Given the ongoing uncertainty, which Sachin will discuss, we remain excited about the go-forward opportunity set within global fixed income. The yield to maturity of the PERS portfolio as of yesterday was 6.3%, which is highly correlated to future returns within fixed income. So I will turn it over to Sachin to provide economic outlook.
Okay, very good. Thank you for that. It's a pleasure to be back here again. By the way,
If you could turn the microphone towards you there, please, that'd be good.
let me. So a lot going on in the markets, but let me focus on a few things that are important for bond markets as a whole. Almost all of them are important actually for all bond markets. Doesn't matter whether it's global or US. Essentially, markets are trying to get a sense around, I think, 3 or 4 major issues with the beginning of the new administration here in US. The top one, of course, being the trade policy. I'll talk about that in a quick minute. Let me just lay them out. Second one is forward-looking trajectory for the fiscal policy here in US, given our deficit and the focus on cost cutting and potential tax cuts. Third is possibility of meaningful deregulation, and particularly from the point of view of bond markets, to the extent some of it may be in the financial services industry itself, and how that might impact various assets. And then more broadly, growth-focused efforts from the administration, the 3-3-3 mantra or other things which may have an impact on our forward-looking growth. So starting with the trade policy. Now coming into the beginning of the administration, markets were expecting some form of shift to a regime of tariffs. But what was announced in Rose Garden 3 weeks ago, I think, or 2.5 or 3 weeks ago, very likely caught the market by surprise. So the initial gambit was higher than expected, which is why we have seen a significant sort of round of volatility as markets basically start to have to price what was announced versus what was expected, right? Now, since then, we've seen a pause. Administration is actively now pursuing many trade deals. At this point in time, we don't have any details, but a lot of positive information or noise that is coming in from various sides. And so I think for markets, it'll be important to see if many of these significant trade partners are able to form or come to agreement on new trade deals. What is the shape of those trade deals, and whether or not they can be relied upon in terms of whether they will last. In the meantime, there is plenty of uncertainty. Because the starting point on tariffs was very large, just looking at economic 101 type of models basically meant that almost everybody had to increase their probability of a significant hit to growth, including here in the United States. A variety of Wall Street firms, and us included, probably see those recession probabilities go up to 40 to 60% sort of numbers, so they're pretty high. But that's all on assumptions that these tariffs will stay as they were announced. If, on the other hand, we get trade deals with a bunch of trade partners, expectations will change quite dramatically. So that sort of gives you a sense of the amount of uncertainty that is out there, from anywhere between just another year or growth being okay to pretty high chance of recession. That's a very wide gap. Now, the trade deals with our major trading partners, I would say, probability is pretty reasonable in terms of engagement. There's a lot of, good initial conversations. It is, however, going to be potentially difficult with China for one very simple reason. It's not just simply a trade relationship. It's a complicated geopolitical relationship. Also, the engagement hasn't been there. And so I think it'll be very important to see if there is an off-ramp, if there is a way that the two countries can negotiate or get into negotiations with each other. That would be very important. Just the act of getting negotiations going will be very important for the markets, you know. So that's sort of number one. Number two, US fiscal deficit. Post-COVID years, initially response to COVID, the deficit went up by a lot. We were not the only country in the world that, which did that. Practically all the developed markets did that. However, our deficit remained pretty high, right? Now, Trump administration is pursuing a couple things which are, potentially can have a significant impact on deficit. One is the cost cutting through Department of Government Efficiency. And the other is possibly looking at, providing even more tax cuts, for growth boosting measures in the outer years. Again, from a market standpoint, the uncertainty is very wide. And the reason is predominantly because it isn't very clear exactly how much, DOGE cost cuts would be, right? That estimate is extremely wide. I mean, I've seen estimates ranging from 150 billion, to almost $1 trillion, and that's a very, very wide gap. Depending upon where the cost savings land up eventually, will give us a sense, or markets a sense of what the trajectory for deficit in US will look like, which will have an immediate impact on what the trajectory for growth look like here in US. Because our deficit numbers are very large and the uncertainty again is pretty wide, the implications for growth can also be a pretty wide distribution, right? And again, that is an uncertainty that the markets will need to price in. Now, as of now, we haven't really seen much of that come through. You all know, Congress is in very initial stages of discussing the budget. We still don't really have a good handle when the DOGE savings will be sort of finalized. There was a timetable for about 1.5 years, but recent comments suggest that sometimes this summer we might have a handle. So there's a lot that is coming here. At PIMCO, we are assuming the fiscal deficit may not change much because on one hand we may have savings, but on the other hand there are new tax cuts that are planned. So overall fiscal deficit may remain the same. The composition may change. There will be some cost cuts and there will be some more tax cuts coming. But that's another thing that the markets are going to look forward to. And that will have a direct impact on not only our growth expectations, but also where the bond yields in US will go. Thirdly, on deregulation. Now, this is early stages. We're only about 2.5 months into the administration. The single most important aspect of deregulation that is relevant for bond markets is the deregulation of financial services or banking system. In particular, there's a whole raft of possible regulations that could be tweaked, recalibrated, or loosened. Those in particular that affect banks holding or purchases or trading of US Treasuries themselves. And so this is something which is ahead of us. I would say we should collectively, individually have pretty high level of confidence that this deregulation will happen for a variety of reasons. Number one, it will help lower the cost of funding our deficit, which makes a lot of sense given the overall posture towards deficit and cost savings. But also secondly, on one hand, the size of the treasury market has kept on increasing over the last 10 or 15 years, but the amount of treasuries that are held by the banking system, which is basically our liquidity provider, they are the ones that help facilitate the buyers and the sellers, that amount of treasury holdings in their inventory has continued to go down, right? And the size of inventory that banks hold is a typical reflection of the amount of liquidity they can provide, to the system. So this deregulation will help or facilitate potentially the banking system to hold more treasuries on their books, which will potentially then help, overall liquidity, but also the cost of treasuries, the financing itself. Right? A quick word on the last few days in terms of price action. I think the initial stages were more about markets coming to grips with what was expected in terms of the tariffs versus what was announced, and that led to a one-off adjustment in terms of expectations around recession, in terms of expectation of what equity should be doing, what bonds should be doing. But a few things to note. Number one, bond market reaction from an investment standpoint was very much textbook. Equities went down, bonds went up. Not only did bonds went up, but also expectations of interest rate cuts, increased everywhere. In US, for example, despite some of the recent statements, which may suggest to the contrary, markets are expecting Fed to deliver rate cuts, taking the rates all the way down to 3% ballpark by the end of this year or early next year. That is quite a long way from where we were just 3 months ago, where markets were expecting almost no cuts from Fed this year, or only about one cut, and the rates would have stayed above 4%. Right? So that's sort of one thing to keep in mind. Secondly, a lot of volatility, which is to be expected when you have a significant change or new information that comes into play. However, when we look at the internals of the market functioning, in general, liquidity conditions have remained, fairly middle of the road. A lot of the volatility came from hedge funds unwinding levered positions, and some noise around, significant move in equity markets up and down, depending upon any new information that was coming. When we look at conditions in, assets where, if you have a cash crunch, for example, in global financial crisis or during COVID, a lot of the assets, people need to raise money, they sell assets, sometimes it's a fire sale, sometimes they just sell them because that's the only thing they can sell. Those sort of things have not happened this time around. And so, broader rise in volatility and some of the noise around equities, et cetera, it's justifiable because you have, a whole host of people who think recession probabilities have gone up, new information has come into play, but generally the market repricing has been orderly. Lastly, big scheme of things, many of these shifts in the US administration policies are going to be potentially negative growth for economies outside of US. Some of it is because they are highly dependent or they have very large current account or trade surplus with US. So if there's any change in the US trade policy, it will affect their trade-related growth. And then there is higher uncertainty in terms of what the new trade relationships look like. Additionally, many of these economies were already slowing down or struggling from a growth standpoint. China, Europe, UK, Canada, almost all of them, even 6 months ago, our own forward-looking growth expectations were pretty weak as it is, right? What that means for bond markets is that bonds in these countries, the yields have fallen more than their counterparts in US, simply because growth is weaker and their central banks need to cut rates by even more than what we need to do here in US to help with the growth. So let me pause here. I'm happy to take questions if you have any, or if there's something that I missed.
Questions? I don't see any questions. Do you have any burning thing that you want to share? One more thing with us here before we go?
I can make a comment on dollar. I was thinking maybe you had a question or not, but it doesn't matter. There is a lot of speculation on whether the shifts in US policies will lead to US dollar losing its reserve currency status. First of all, things like reserve currency status, these things don't happen or change over months or, or quarters. They are multi-year horizon issues. The single biggest thing that needs to happen in order for any currency to lose reserve currency status is for there to be an alternative, right? So firstly, there is no alternative to dollar in its any comparable size or liquidity, or for that matter, credibility. There are smaller alternatives like Euro and China, but they are not really comparable to US, our markets, or the depth or liquidity. Secondly, it isn't clear that, I think it would be too presumptuous to sort of worry about a reserve currency status. However, foreigners own a lot of US assets. And frankly, they've made a lot of money by owning a lot of US assets, A lot of it is because US equities have very handily outperformed over the last 10 or 15 years when a lot of this has been built up. And some of it is because US dollar has also outperformed over this period. And so foreigners are sitting on a lot of US assets that have made a lot of money, particularly over the last 10, 15 years. So what is more likely or somewhat of a risk is that some of these foreign holdings, that there is a temptation to hedge them somewhat, because just lock in the profits, which is very, very different than any risk of reserve currency status being lost or not. So that's the only other comment that I would make, but otherwise, nothing else from our side.
I don't see any more questions at this time.
How'd you persuade Janet Yellen to go to work with you all?
Well, this would now be the third ex-Fed chair
Really?
to come and consult with PEMCO. The first one was Alan Greenspan when he retired.
Impressive.
The second was Ben Bernanke, and third is Yellen. So it's not she's not the only one. And I guess it's because they probably want to come and consult with us and talk with us and sort of exchange ideas with some of the minds here at PEMCO.
And not related to that, I have interest in world hunger, and you're part of the Global Food Banking Network. What is that?
Well, it's something I do in my private time, but it's an NGO out of Chicago, which is a network of food banks, I think in about 57 countries outside of US. And they help fund and incubate food banks all over the world to sort of get them to a place where they can serve those communities. So it's fantastic.
My church is involved in a lot of that, as these people are here, I'm sure.
The Feeding America is not a part of this network, of course.
Hungry people everywhere.
Yeah, but it's
But not in Clinton, Mississippi.
Yes.
So Chloe, how many years did you say we've been associated with y'all now?
42.
30?
42.
40?
Yes, sir.
2? I think our lack of questions demonstrates our confidence in you, so I would say thank y'all for coming here.
Thank you.
Thank you.
Yes.
I've been affiliated with
Got a little makeshift mic stand here, so hopefully this works. Hey, Skylar, do you want to give a quick test to see if we can hear you?
This is Skylar Reese in Boston.
Did everyone hear that loud and clear? Awesome. Well, it's great to see you all here today. I can start off with some quick introductions. My name is Brendan Crouch. I work out of our Chicago office in Wellington. I've been based there for 9 years. I am an associate relationship manager focused on our Midwest institutional clients. We're currently joined here by Skylar Reese. He is a partner of the firm, and more specifically to your portfolio is a corporate debt sector specialist. So I know we have 20 minutes. I know you know Wellington well. Obviously, there's a lot going on in the markets. There's a lot to talk about. So happy to jump right into the portfolio if you think that's what's best, or happy to answer any firm level questions. We can use this time as you best see fit.
All right, go right ahead.
So with that, Skylar, maybe I'll turn it over to you. I guess maybe I'll quickly check. Does everyone have the deck in front of them? Great. So if we could maybe start, do you think it makes sense to jump into performance and attribution over the period, Skylar?
I thought I might just quickly, Brendan, touch on the team and then move into performance over the 12 months ended in February and attribution as well.
Perfect.
So page 7 will be where I'll start my comments. My name is Skylar Reese. It's a pleasure to speak with you folks today. I am a portfolio manager on the emerging market debt team. My focus is on corporate credit, but I partner very closely with Kevin and Evan on strategy setting for our traditional emerging market debt strategy in which you are invested. Just as a reminder, as you know, the strategy looks to outperform the MD Global Diversified benchmark. We can use predominantly hard currency, sovereign bonds, in addition to out-of-benchmark exposures like local rates, emerging market currencies, and corporate bonds, which are my area of expertise. From a team perspective, the quick message that I want to pass along today is one of stability. Kevin, Evan, and I we're not going anywhere. We do have one update, one addition, and one subtraction to our team of sovereign analysts. So these are the researchers who help us come up with the ideas, which we will populate the portfolio with. You'll see in the center of this page, Dan Buxa. He joined us from Unicredit, where he was the lead Central and Eastern European macro strategist and economist. And he's joined us to cover the same countries here at Wellington. Unfortunately, Gabriel Tenorio, who you would have seen as a LATAM macro strategist, just departed for a different opportunity earlier in 2024. And we have actually a sixth member of this team who will be starting in the next 3 weeks, which we're very excited about, although we can't share his name with you today. Just quickly, just on our platform, current AUM for our emerging market debt business is about $30 billion, of which about $5 billion is in the traditional EMD strategy in which you guys are invested. We saw about $1 billion of net outflows last year. This was principally driven by a single client in Japan who was facing very, very penalizing hedging costs to hedge their dollar portfolio back to yen. Compositionally, we're seeing a lot of interest from insurers globally looking at emerging market credit, in some cases for the first time, which has been positive from a flow perspective. And then offsetting that beyond the flow I described from Japan, we've seen generally de-risking from U.S. pension clients who own emerging market debt as a return-seeking asset and are looking to de-risk their fixed income allocations.
Any questions?
If no questions,
the platforms? That's a no in the room, Skylar.
If you would, please tell us what page you're on as you go
Oh,
through.
sorry. Page 7 was the investment team, and
Okay.
8 was the platform.
Thank you.
And so if no questions, Brendan, I'll steer the group to page 9 to talk about investment results, and then I'll get into attributed performance.
Perfect.
So on page 9, for the 12 months ended at the end of February, which is the period that we'll be presenting the attributed performance for, you'll see that the fund returned 10.85%, so a very healthy return for fixed income, which outperformed the MD Global Diversified, which had a 9.82% return over the same period, so just over 100 basis points of alpha. Similarly, if you look at the calendar year performance for 2024, returns were quite strong. In this case, for the portfolio, north of 7.5%. So I'm looking in the middle of the page here for 2024. And again, roughly 100 basis points of alpha relative to the benchmark. So it was a strong year for emerging markets and fixed income in general. If you turn to page 10, there's a little more detail specifically about the returns for emerging market debt assets. In the center of the page, you'll see both the hard currency sovereign, the hard currency corporate, and then the local debt index. Again, very strong returns, nearly 10% for sovereign bonds, nearly 9% for corporate bonds. This was driven both by lower treasury yields. You guys will, of course, remember that, in the late summer, early fall, the Federal Reserve started to cut interest rates, having, substantially increased them since the beginning of 2022. So this drove sort of basically an equal tailwind between lower treasury yields, particularly in the front end of the curve, as well as tighter credit spreads in both sovereign and corporate bonds as default risk premia fell globally. And the only difference for local markets was, here there was effectively, small positive returns from rates, but currency was a very negative return, as up until the early part of this year, the dollar had been incredibly strong, and that weighed on emerging market currencies last year and into the early part of this one. Page 11, Brendan, has a bit more detail about some of the exciting things that were happening underneath the hood in the hard currency sovereign bond market for the 12 months ended in February. So as I look at this page again, you'll see on the top right that of the nearly 10% return for the benchmark, it was roughly split 50-50 between interest rate and credit spread in terms of the drivers of that return. And globally, I think what is interesting to me is that low quality credit definitively outperformed last year. And we can think of this as being sort of the opportunity that we were trying to invest around as a group was a recovery from some of the shocks that the global economy had endured in 2022, both as a virtue of, the Federal Reserve, really dramatically tightening interest rates to combat high levels of inflation, as well as some of the shocks globally to prices, particularly commodity prices and energy prices from Russia's invasion of Ukraine. I think I'd specifically want to point out that, nearly a 13% return in African credit. This is some of the highest yielding bonds in the universe, as well as, very, very eye-popping returns on the left-hand side of the page in countries like Argentina, Ecuador, and Ukraine, where you're well into double digits. And in the case of Argentina, not that far from triple-digit returns as the new president, Milei, really was able to thread an incredible political and economic needle last year and please markets. So sort of with that background, Brendan, I might suggest we move to page 12, which has the high level attributed performance for the fund for the 12 months, again, ended at the end of February. We're pleased to have driven, gross alpha of over 100 basis points. I think what's most important again here to emphasize is that the sources of those alpha were principally driven by country allocation and security selection. Those would be the two large blue bars on the positive side of the histogram here. And again, this is where we would expect to drive a lion's share portfolio alpha over time. We'll see the credit spread duration. So this was sort of a call on market directionality was a modest drag. And that local markets, both local duration and currency, had very, very modest impacts on performance. Page 13 has a little bit more exciting and helpful detail, I think, on the attributed performance for the period. So stylistically, I would want the group to walk away, understanding that, we saw both winners and losers from our overweights and our underweights. We saw winners from both our overweights and our underweights. On the left-hand side of the page, you'll see countries like Ukraine, Indonesia, Qatar, Philippines, and Chile were among the largest contributors to our performance last year. Sort of two themes which I would pull out from these. One, the latter four countries, both the Asian, Latin American, and Middle Eastern countries that I referenced. These are sort of low spread, low risk countries that just weren't set up well to perform in a market where credit spreads were compressing as rapidly as they were. So these underweights all worked quite well for us. And in some cases, we also benefited from positive security selection. So that would be sort of the darker blue part of the stacked histogram. And, here, this might reflect sort of our preference for corporate credit instead of sovereign bonds in some cases. Ukraine was a very, very different story. I mean, this is one of certainly the most exciting things that's been happening in the world of emerging markets credit since 2022. But last year, the big call in the market and in our portfolio was when and how Ukraine was going to restructure its debt in light of the fact that its economy had changed and its capacity and ability to repay its debt had changed markedly since Russia's invasion in 2022. So we were deeply involved in the restructuring process, one of the guiding investors, as we were trying to maximize as much value as we could from a very tricky situation. And ultimately, this was a large position which benefited us, particularly in the post-restructuring period. So the restructuring was completed sort of in midsummer of last year. And especially as President Trump was elected last fall and promised to end the war quickly, you saw fairly rapid gains in Ukrainian bond prices. And clearly, this was the largest contributors to return for us during the period. In terms of what didn't work, I think another really interesting anecdote for the group would be Lebanon. And, here we didn't have any portfolio exposure at all. Lebanon has been a poorly managed country and economy for a long time, probably something approaching, a failed state, if you will. But what was interesting last year was that as Israel prosecuted its sort of two-front war, both against Hezbollah and Hamas, it actually helped to improve political stability in Lebanon in a way that we just weren't prepared for. It felt risky. Lebanon has, again, been a failed state for several years now. But in light of the significant degradation of Hezbollah's military capacity, it's actually the case that Lebanon seems to have emerged stronger. And we were just on the wrong side of this trade, unfortunately. So you'll see that as our largest detractor to performance. And then just one other sort of interesting theme from the trades that didn't work would be local markets. So those would be particularly local interest rate markets in Mexico and Colombia weren't successful trades for us last year, small drags. And again, this was really a function of the markets being unsure about how quickly both the Mexican and the Colombian central banks were going to be able to react and ease policy, having aggressively tightened policy, again, alongside the Fed, over the past 18 to 24 months. But unfortunately, those were sort of modestly detracting trades as well. Perhaps I'll stop there to see if there's any questions on performance and attribution.
Looks like none in the room, so maybe move on to Outlook.
Yeah, of course. So Brendan, I'm on page 14. So I'll quickly talk about Outlook, and then I'll try to tie that to our positioning, which is on page 19, that I'll get to in just a minute or two. So entering 2025, I think Kevin, Evan, and I had pretty high confidence that, a period of something like market nirvana was likely to continue in light of seemingly high levels of cooperation between the Trump administration, the incoming Trump administration, and the market that would have extended what many people have called like a period of American exceptionalism. The past month or so have really challenged that view, and we've needed to adjust our portfolio positioning accordingly. I think we've been surprised about how dogmatic President Trump and members of his administration are about trade policy and how willing they seem to be to absorb some of the consequences, particularly with respect to growth of such hawkish trade policy. In a simple sense, what I would want to convey to the group would be that we think of tariffs as effectively being taxes, and that taxes are going to have a very negative effect on growth, and we expect a pretty significant slowdown, both in U.S. growth, but for the purposes of this portfolio, also emerging markets growth as well. And, in our minds, this means that the macro backdrop, which is the first step in our team's investment process, has, begun to sour. And having entered the year with a more optimistic view on credit quality, on credit spreads, we've needed to really rationalize that. And we've been working hard to adjust portfolio positioning from, a fairly aggressive position, in terms of directional exposure to the market, to one that's much, much more modest. Valuations in our market have improved as, uncertainty has increased over the course of the past couple of weeks. But still, as we look across the menu of credit markets that we can invest in, and also local rate and local currency markets, we still think that perhaps, prudence is the better part of valor at this point, as we, sort of just look out into the future at a more uncertain investment backdrop. Maybe I'll stop there. It wouldn't be a meeting about the emerging markets if I didn't get a question about the outlook and tariffs. So I better stop there, Brendan.
Questions?
Doesn't look so. So maybe we can move on to positioning.
Yep, of course. So with the understanding that, the materials that we presented are a bit dated. So these are as of the end of February. At the time, risk exposure was fairly aggressive. The preferred risk metric that our team uses would be the ratio of duration times spread relative to the benchmark. And again, this would sort of approximate the riskiness of our fund relative to the benchmark. And, at the end of February, it was fairly aggressive, and it's been cut by, probably our benchmark relative risk posture has been cut by about 15%. So it's much closer to neutral. You'll see compositionally the way that we are choosing to invest, favors out of benchmark exposure to corporate credit. This is, again, my area of expertise, but it's also, I think, interestingly, the part of the market where we have the highest conviction in fundamental quality. We think of companies as perhaps being better suited to absorb a slowdown in activity than sovereign borrowers, in light of the fact that there are sort of structural frictions and certainly some political constraints in some cases to countries being able to rationalize, particularly spending, very quickly in a period of lower growth. So we're trying to tweak lower our exposure to directional risk in the market, reducing exposure to sub-investment grade credit, and then perhaps, we do have a modest overweight to local rates today, which I think is perhaps the one place which we think could be a beneficiary of lower global growth, and that it eases constraint on some central banks in the emerging world and their ability to cut rates if the global cycle does slow down in the way that we envision. Page 20, Brendan, just really quickly has our exposures across the world. Again, this stacked histogram reflects the different asset classes that are available for us to invest in. The sort of orange bars are sovereign bonds, quasi-sovereign bonds are in yellow, purple is corporates, and then our local exposures, are going to be in light blue or dark blue. I think regionally, what you should look at here that might be of interest, we do have a decent amount of exposure to Latin America. Thematically, I think of the U.S. as perhaps moving to sort of a more isolationist foreign policy stance, which actually could benefit Central and South America in a way which, means that they should be largely spared from some of the worst tariffs that seem to be facing some of the other, major global trading partners. And then the largest underweights will be both in Asia and in the Middle East. And in Asia, I would think the group should walk away, thinking that this is a place which, is likely to be more negatively affected by tariffs. We have much larger bilateral trading deficits with countries like China, Korea, a few others. And then the second largest big underweight I want to highlight is in the Middle East. And here, this is both a comment or reflection of, lack of value in some cases, but also our concern about downside to the oil price, in light of the fact that, President Trump has made a stated policy to push energy prices lower, and we see, potential for significantly higher supply from OPEC Plus in the year ahead. I'll stop there, Brendan, to see if there's any questions about positioning.
Any questions or anything else helpful that Skylar could touch on?
got one over here.
Here we go.
I know you touched on it briefly with respect to your positions in Ukraine. Can you talk a little bit about that, the extent of that exposure and how long it's been invested and the likelihood that that will be money good at the end of the day?
Were you able to hear that, Skylar? Yep, okay.
Yep, I heard the question. Thank you. This is another topic which has come up in most meetings. So if you look on page 20, in the second group of countries down from the top, those are sort of Eastern European and Central Asian economies. Within that second grouping, Ukraine will be the bottom, the second to the bottom exposure. So you will see that as of the end of February, we were overweight Ukraine. The benchmark weight is the black hash mark, and then the combined orange and purple is our corporate and sovereign bond exposure. Last year, this was a very profitable trade for us. And I think many in the market expected President Trump to be successful in his desire to reduce, to end the war in Ukraine quickly. And I think where our out of consensus view has been recently, and we've been reducing exposure quite quickly over the course of the past couple months, has been that President Trump faces significant constraint in his ability to end the war quickly. And that decision is unpopular with the Europeans, but also much more importantly, it's not obvious to us, us as investors, that ending the war actually benefits Russian President Putin very quickly. So I think that what we've tried to take advantage of has been the strength in Ukrainian bond prices since that restructuring completed in the sort of last summer, acknowledging that the outlook for Ukraine is a little bit murkier. I think our conviction is lower. Are the bonds going to be money good? It's really a question of how long the conflict continues. And so the bonds, I would think of as being certainly money good in a world where the war ends at some point over the course of the next 12 to 18 months. If the war extends beyond that period with the support of the U.S. and its allies, my suspicion is that Ukraine will try to find some type of agreement with bondholders to pursue another standstill, but not look to pursue like a haircutting exercise. If the war sort of continues endlessly and support from the U.S. is withdrawn completely, it will be very difficult for Ukraine not to face a much harsher restructuring in light of the fact that its economy just simply won't be able to recover in the way that both investors and official sector lenders like the IMF and World Bank expect them to over the course of the next couple of years.
Thank you.
Any other questions for Skylar? Great. Well, if that's it, we're always happy to answer any follow-ups that you may have. We're always happy to, get on a VC and talk through anything else that's going on in the market. But I really appreciate your time today. And thank you again for allowing us to use the dial-in option as we dealt with some scheduling conflicts.
We thank you.
And Brendan, just one word from me. It's a pleasure to speak with a client of our team's who's almost about to celebrate their 15-year anniversary invested in the strategy. That is a real privilege. So thank you for your time today. And as Brendan said, if you have any questions, please reach out.
Any further questions? If there's not, we thank you all for coming and celebrating the 15 years of working with us as well. And I hope you have a safe trip back home.
Great. Right. Appreciate it. It's great seeing all of
you.
you. Thanks, Skylar.
Thanks very much. Bye-bye.
Bye. I believe that concludes our non-U.S. fixed income manager presentations. We're going to miscellaneous.
I have one last item to cover, and that's some miscellaneous updates. The first item is on a partnership between Mitsubishi and Brown Brothers. This partnership basically is going to expand their footprint, being able to increase the amount of volume in lending that both of these firms are going to be able to do. So potentially our program benefits greatly from this. I included a article on this from the Securities Finance Times. And the final item is just some information from Artisan Partners, a mid-cap portfolio manager of ours. Eric Colson's going to be stepping down as CEO, and Jason Galib will be taking his place. It's just basically a long-term succession plan. Has no impact on our portfolio management, but is for your information. And that is all I have, sir.
Okay, any other questions, or comments before we, dismiss?
No, sir, nothing for today. Just start with the committees tomorrow at 10 a.m.
10 a.m. in the morning, so the investment committee is adjourned. We'll see y'all at 10 in the morning.